We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Looking ahead in the context of the inevitable continual emergence of new variants, the importance of developing a pan-coronavirus vaccine, namely one that would be effective against all SARS-CoV-2 variants and ultimately against all coronaviruses, becomes even more apparent.
A difficult time on Capitol Hill in the last 24 hours for Dr. Anthony Fauci, the White House chief medical advisor. From New York with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Going into a CPI report at 8:30 Eastern, futures higher, 7 points higher, up by 0.1% and some. On the Nasdaq, up 38, advancing 0.25%. Tom Keene, yields unchanged at 173.93 on 10s. Euro dollar not doing much at 113.59, and crude up 0.75%, heading towards 82 on WTI, Tom, 81.83.
Right where I'd go, 84.15 on Brent crude. I'm watching that carefully. A print of 87 would be a huge, huge deal. A gallon of gas, AAA unleaded, folks, is about 13 cents under the peak price of autumn. That's about the gap there of how we've come back on a gallon of unleaded. Bhakti Hansadi with us now on this pandemic. Associate Professor of Emergency Medicine at Johns Hopkins University. Bhakti, a completely unfair question, but it came up, I think, 3 times yesterday. What is your timeline of when Omicron ends? Is it weeks? Is it months? Is it all of 2020? What's your scope of the x-axis of Omicron?
Absolutely. So if you look at South Africa, I would have said 30 days. However, we've peaked much higher and our population is inherently different. So I'm really thinking months. I am not thinking that this is going to affect my summer plans. So I remain hopeful, right, that we're going to get past this peak soon.
So, seriously, you think Omicron will be wiped away by the 4th of July?
Absolutely.
Why do you say absolutely? How do you get to that certitude?
So I think the fact is that when it peaks so quickly, we expect the fall to be just as significant. We're already seeing in New York and in Washington, D.C., that there is now a reduction in cases, which, it's very, very early, but it makes me hopeful. Plus, again, we're looking at South Africa and the United Kingdom. So in United Kingdom, we've started seeing a taper. South Africa, from the first rise in the peak to the end, was around 30 days. So the viral transmission cycle here is smaller, which makes us more hopeful that this will end sooner.
As we are more hopeful that the pandemic will end more broadly and become endemic, we're left with a healthcare system that has been transformed. I'm struck by the number of employees who have left the profession, about the wage increases that they're demanding in order to stay there. How much does this healthcare sector look completely different than what we saw 2 years ago?
So I think like the healthcare workforce is just one piece of this puzzle. The health system here in the United States is extremely complicated with what is the role of insurers, right? And how have they supported the COVID-19 response? Now we're also hearing that some insurers are going to start covering COVID tests, which I think is helpful, right, for future pandemics. But is that going to be the norm? And how will they step up in the future? And what is the power of the health system versus the state versus the individual hospitals in developing your surge preparedness plans? I think there is a lot of learning to be done. I think we're talking about a series of after action reports, and hopefully there is a new way of us thinking about how does a health system support in a more unified utilitarian manner.
What's the answer to getting people in the doors at hospitals at a time when we see massive numbers of vacancies that, frankly, a lot of health executives have said are unprecedented?
You know, I don't think money is the only answer. It's very easy to say, we'll just pay you more, but you need to make this work environment kinder, right? Healthcare workers are also human beings. We have the same needs. So let's talk about what it means to be able to have children when you're a healthcare worker, looking after patients who are infected. How do we manage sick leave? How do we give people time to recover? What psychosocial support services are available? So it's really not just more money. That is a stopgap measure. We need to look at the healthcare workforce as a whole and think, how does this become a place that people want to work, and how do we bring back the passion of medicine?
Doctor, can I just squeeze in a final question and go to this statement from Novak Djokovic, the tennis star, who tested positive with a PCR test. And the following day, on December 18th, he went to his tennis center in Belgrade to fulfill a long-standing commitment for an interview and photo shoot. He felt obliged to go ahead and conduct the interview. He did ensure he was socially distanced and wore a mask, except from when his photograph was taken. Doctor, for someone in your industry right now, how do you react when you hear something like that?
You know, I just think there's cognitive dissonance, right? They haven't seen the worst of the pandemic. The worst of the pandemic sits in ICUs behind closed doors. So, you know, he treats it like a common cold, and that is why we are here where we are, right? Because of individuals that make decisions like that. I think my eyes roll over, you know, to be honest. And I think, well, I hope you just don't come to the emergency department for a test.
Doctor,
and good luck.
Thank you for being with us. We appreciate it. Dr. Bhakti Hansati there of Johns Hopkins University. Tom Keene, right now, it's very difficult to like Novak Djokovic.
I'm going to stay out of it, John. I mean, the opinion of what I think about athletes is something, but I just don't understand why they get a favored status here. What I'm far more concerned about, John, is thousands and thousands of people at Georgia, Alabama. When I look around and the streets are empty, I just, you know, it's unique. I mean, I assume English football, John's the same way.
Well, Tom, how many people knowingly went to that game with a positive PCR test? I would hope none. I think if you're negative,
wrong. I think
and you can
a lot
get back,
of people did.
You think they knowingly went with a positive case of COVID?
Yes, absolutely. I mean, look at Spurs Chelsea today. John, I don't understand this. If the Tots score 2 goals, they're still behind.
Tom, I don't think we can avoid what you just said because it was highly speculative. We know for a fact what Novak Djokovic did.
Yeah.
I don't know who's turning up for a game or not. I think if you're negative and you've tested and you're negative and you have no symptoms, you can go to a sports game and fill out the stadium.
But there's a larger point. And just to break in here, and Bhakti Hansati was saying this cognitive dissonance where a lot of people treat it like the common cold, whereas in the emergency room, people are seeing something very different. How much are people taking a more laissez-faire attitude to the personal responsibility of covering up and not exposing other people because they see this as something minor versus something that can develop and become more extreme in certain individuals? And it goes to a messaging point, John, where how do we communicate? It doesn't have to necessarily transpire as a severe illness in everyone to have a serious impact on society.
Well, how do you have the messaging when one of the world's biggest sports star, one of the world's biggest tennis players behaves like that?
Yeah.
I will weigh in. I think it's completely irresponsible, and I think that a lot of people would agree. And I think that right now that's what the outrage is about at a time when people are conflating personal responsibility with freedom, and there is a difference between the two.
I should disclose, I'm a massive Rafa fan, okay? Just to throw that out there.
Oh, come on. That totally undermines everything you said about him.
Well, I just think it's fair, just so people know
Okay,
that.
who's Rafa?
Oh, Tom
Really?
Keane, Lisa Abramowitz and Jonathan Ferro. Futures up 7 on the S&P. I don't think he is, Lisa. Up a little more than a tenth on the S&P. On the Nasdaq 100, up 39, up 1/4%. Yields up a single basis point on 10s to 174.28. Your economic data
I know who
out.
Emma is. I don't know who Rafa is.
8:30 Eastern Time. Your estimate has a 7 handle, 7% inflation. The range 6.8 to about 7.2 in our Bloomberg survey. From New York, this is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
Actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does.
What the Fed is up to is signaling that they don't like these entrenched inflation expectations.
Every sector, every component of the inflation metric is moving higher.
If you see that hot economy start to be questioned,
that's when markets are really going to have a problem.
The Fed is worried about inflation, feels like they might have lost control of it.
I think they should go faster than what's priced into the market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
90 minutes away from economic data in America. From New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market up about 2 or 3, not even 1/10%. A big data point, Tom, dropping in about 90 minutes time.
Yeah, we see that at 8:30 CPI inflation already, John. I have failed. Surveillance correction is retail Friday, John. Not retail Thursday,
Friday,
as I mentioned in the last hour. You know, we make jokes about it, but John, this is not a normal CPI reading. Everyone's going to be focused on the stunning 7% statistic.
I wonder, Tom, also what the read will be on retail sales later this week, given what we know about Omicron and how many people backed away from engaging in this economy over the last month or so.
Well, they're engaging in the economy, and what I would know across all of December and the holidays, John, it was Partygate here in America, Partygate for team surveillance, and I believe, John, right now, not to interrupt the opening of the show, but I think it's Partygate in London.
Would you like to go live to Parliament,
I think
Tom?
we should.
Is that what you're suggesting?
I
the
would
Prime
suggest
Minister,
it's packed.
The British Prime Minister Boris Johnson facing down questions. His PMQ's taking place any moment now, Tom Keene. And as I understand it, the reporting suggests he has been granted a couple of minutes to speak. Do we have the sound of this?
To know that
Let's take a listen.
We simply did not get right. And I must take responsibility. Number 10 is a big department with the garden as an extension of the office, which has been in constant use because of the role of fresh air in stopping the virus. And when I went into that garden just after 6 on the 20th of May, 2020, to thank groups of staff before going back into my office 25 minutes later to continue working, I believed implicitly that this was a work event. But, Mr. Speaker, with hindsight, I should have sent everyone back inside. I should have found some other way to thank them. And I should have recognized that even if it could be said technically to fall within the guidance, there would be millions and millions of people who simply would not see it that way. People who suffered terribly, people who were forbidden from meeting loved ones at all, inside or outside. And to them and to this House, I offer my heartfelt apologies. And all I ask is that Sue Gray be allowed to complete her inquiry into that day and several others so that the full facts can be established. And I will, of course, come back to this House and make a statement. Mr. Speaker, this morning I had meetings with ministerial colleagues and others. In addition to my duties in this House, I shall have further such meetings later today.
Dr. James David. Mr. Speaker, my constituent Carol Ridgway faces 8 weeks of stress and worry as she waits for an urgent appointment at the local breast clinic in North Wales. Yet, despite the pandemic, 85% of patients in England wait only 2 weeks for their urgent suspected cancer.
The Prime Minister is going to face a series of questions now in Parliament, Tom, and this is going to get pretty heated over what happened in spring of last year. And for a lot of people reducing to this as just a drink in the garden with colleagues, for a lot of people around that period, Tom, who lost loved ones, couldn't attend funerals, couldn't meet the birth of their grandchildren, their babies. Tom, this has been a massive, massive issue in this country and will continue to be so in the coming weeks and months.
John, is there an American equivalent? I just don't see it I can't imagine President Biden going through this exercise, but do you see an American equivalent?
Not right now. No, Tom. Not right now, no. The Prime Minister is going to face some questions through the next 30 minutes or so, and Tom, if there's any headlines, we'll bring them to you. The main event stateside, 8:30 Eastern Time, CPI in America. From the pandemic to the inflation pressure we've seen off the back of it, Lisa, 7% is the estimate.
Yeah, and how much does it actually change the narrative, which already is for a stickier pace of inflation? How much is it going to be the 7 handle, the sort of shock factor of seeing inflation at that high of a rate versus the underlying components? I keep going back to this. How much do we need to see a transmission from the goods inflation to the services inflation in order to give rise to the stickier feel that we keep hearing?
The Fed conversation in the mix in a big way as well. Let's get to the equity market, up 5 on the S&P, up a little more than 1/10%. On the Nasdaq 100, up 32, up 0.2%. Yields on 10s, 174.28. Yields higher by almost a basis point. Joining us now, Sebastian Page, CIO and Head of Global Multi-Asset at T. Rowe Price. Sebastian, let's start with that inflation print a little bit later this morning. What are you looking for, sir?
We have a range of view at our firm and pretty much everywhere about inflation. 7% looks reasonable. That's the consensus. When we discuss in our asset allocation committee where we expect the CPI to print year over year at the end of this year, our base case is 3%, but we think risks are skewed to the upside. And for that, you really have to watch the supply chain factors. And they're pretty confusing, Jonathan, right? The Baltic Dry Index is actually down 60% from its peak, the cost of shipping stuff. But then you have 100 ships in the ports of Los Angeles. You have Omicron creating more and more issues. Jonathan, you mentioned people not showing up for work at the airport. A third of the workforce for United mentioned this earlier. So the supply chain remains a puzzle. The New York Fed has put out an index of supply chain pressures, and their narrative is that it's peaking. But when you look at the data, I don't see it. I have it on the Bloomberg. It just keeps going up. So we think the risks are skewed to the upside, and we've positioned our portfolios to be short duration.
Sebastian Page, the heritage of T. Rowe Price is absolutely unique. You guys invented growth. You invented sector analysis on the buy side. I go back to Roger McNamee and what you guys did in technology. T. Rowe Price right now in honor of Roger McNamee on American technology and American growth stocks. Am I long?
At the moment, in our asset allocation portfolios, we have tilted towards value. And we like being long cyclicality because it's a relative valuation call and also a macro call based on the economy. Now, Tom, I got to be really, really clear. We still believe in the role of technology. We're still diversified between growth and value. But as asset allocators, we think the cyclicality is so underpriced. All-time extremes in terms of relative valuations. It's already sort of playing out so far this year. And you have rising rates, which is good for financials or analysts on the platform or upgrading financials. So that's how we're positioned tactically.
Sebastian, how much is that call for value hinged on this idea that the Fed will not be forced to move too quickly, will not necessarily become or move to a restrictive monetary policy, and that the data will cooperate and allow them to do so?
You know, it's interesting because over the last few weeks, Lisa, we've priced in quite a bit of additional Fed hawkishness. Right now, we're talking about 4 rate hikes. If I go on WIRP on my Bloomberg, I see 3.5 rate hikes for 2022. Powell yesterday confirmed or talked about balance sheet runoff, and the markets reacted okay to that. So the question is not, is the Fed going to be hawkish or not? It's more, can the Fed still surprise on the hawkish side relative to what's priced in at the moment? Our view is the direction of travel for rates is higher this year, and that's why we're short duration. But what we really are looking at right now are the long-term dots. They're at 2.5%. They've been at 2.5% since 2019. Will the long-term dots change? And that could be the kind of tail risk hawkish surprise. It's very hard to bring those up because we've piled on so much debt over time. We had 10 trillion treasuries outstanding around the global financial crisis. We have 30 trillion treasuries outstanding now. How have we done that? We've done that by lowering rates such that debt service, if you plot it on the same chart, is almost a flat line. So you get trapped every time you add debt, and we've added a lot in terms of government debt. You handcuff yourself in terms of where the rates can end up. So that is where the surprises could come. But nonetheless, our positioning right now is towards longer rates, higher rates.
Sebastian Page of T. Rowe Price, really summarizing the big debate right now in the bond market and on the dot plot. Sebastian, thank you, sir. Thank you very much. What did Bill Dudley call it earlier this week, Lisa? The long dot the 2024 dot to be precise. You think he called it Fantasyland?
Yeah, Fantasyland.
Federal Reserve.
That basically they thought that it was going to stay so low. However, on the other side, you have Stephen Major, and going back to that note this morning where he talked about perhaps going long the short end and seeing some value there and seeing a further sell-off at the long end. That's a tactical trade. He still has the same view that we just heard from Sebastian Page, that long-term rates cannot go up that high simply because of the amount of debt and how difficult it is to get to that higher terminal rate in a longer-term basis.
This is the self-limiting cycle, the self-limiting sell-off, Tom, that a lot of people have been discussing at the bond market for a while.
Well, other things come in. The biggest problem here, John, is the static analysis of many people that are in the game, but also the static analysis of the financial media. And we at Surveillance refuse to do that. I mean, we've got Alicia Levine coming up. Just like Sebastian Page, these people think dynamically. I mean, there's moving parts here that don't get you to the certitude of a given view.
Alicia Levine coming up a little bit later this morning, 8 a.m. Eastern Time of BNY Mellon Wealth Management. Looking forward to that. Looking forward to the economic data as well. 8:30 Eastern Time, CPI in America. Your estimate has a 7 handle. You know that already. We haven't seen a number like that for 40 years in the United States of America. With Tom Keene, Elisa Abramovitz and Jonathan Ferro, your equity market essentially unchanged on the S&P and on the NASDAQ 100. Yields up a single basis point to 174.64. Euro dollar not doing much at 113.63. And there it is. That grind higher continues on crude. WTI up 0.7% to 81.79. Heard on radio, seen on TV from New York City. This is Bloomberg Surveillance.
With the First Word News, I'm Leanne Gerrans. The U.S. Consumer Price Index coming out today is expected to show that inflation climbed to 7% in December. That will be the most since 1982. That will keep markets' attention on a Fed rate liftoff as soon as the March policymakers meeting. The CPI data is released at 8:30 in New York time. Meanwhile, Federal Reserve Chair Jerome Powell is trying to convince lawmakers and investors that the central bank can pull off a tricky task, that is to bring down the highest inflation in 4 decades without damaging the U.S. economy. Powell told a Senate confirmation hearing the Fed is on path to start raising interest rates and reducing its balance sheet. Here in the UK, the rapid spread of the Omicron variant led to a spike in the number of people missing work last week. According to analysis for Bloomberg News, employee absences rose 18% compared to the same period in 2021. In all, it is estimated that 3.1 million Brits were affected last week. Now, Morgan Stanley will raise annual bonuses for its best performing staff by more than 20%, reports say. According to Reuters, bankers in the equity underwriting and M&A advisory business are expected to get the biggest raises. Morgan Stanley is not commenting. And in Australia, tennis star Novak Djokovic has broken his silence. Djokovic admitted he attended a newspaper interview and a photo shoot last month when he knew he was infected with coronavirus, and he blamed human error for an incorrect travel declaration. He is still waiting for the final decision about whether he'll be allowed to stay in Melbourne for the Grand Slam. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
When you think about schools in particular and children, where we've seen pediatric hospitalizations actually on the rise amid the spread of this variant, do you think keeping schools open is the right move?
If done well, school is a relatively safe environment for kids. Masking, tests, especially during the surge of cases, I think it is very important for kids to be in school, and I think the chance that school becomes an explosive source of new infections is low with precautions.
10 million cases in just a week. Are we reaching a peak of this wave, considering how quickly it is spreading through the population?
I think at a certain point it really has to slow down, and that's probably within a couple weeks or a few weeks away. And that's, I think, going to be good news. The question is, can we keep hospitalizations down enough during this period so we're not swamping hospitals?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
I believe the threat to our democracy is so grave that we must find a way to pass these voting rights bills. Debate them, vote, let the majority prevail. And if that bare minimum is blocked, we have no option but to change the Senate rules, including getting rid of the filibuster for this.
The President of the United States, Joe Biden, there. From New York City with Tom Keene, Lisa Abramowitz and Jonathan Ferro. Tom Keene, how many times have you been asked, why can't we have PMQs in America?
Yep.
Prime Minister's questions.
Yep.
Could you imagine if we had a little bit of this every Wednesday with the President going down to Congress to face these kind of questions?
On radio right now, this gentleman speaking here in the green leather of the House of Commons is someone who's been on surveillance many times with Francine Lacroix. John, explain the sport here. What is the risk of resignation to the Prime Minister?
Well, right now he's clearly waiting for the conclusion of a review as to what happened in May last year, or May 2 years ago, Tom, May 2020. The investigation is being run by a civil servant, a senior civil servant, Sue Gray, and the Prime Minister keeps referring back to that, Tom. So for now, the risk is low, but obviously in the next couple of weeks, if this doesn't go away and the polls start to move against him in a more material way, Tom, the pressure's going to ramp up.
I think we do better in Capitol Hill with that big gold thing they've got there on the table in front of them.
You think that's what we need, Tom?
That would work.
Why don't you ask a man who could maybe make this happen?
Let's make this happen. Let's make this happen right now. We're going to turn to politics now and the delicacies of this early 2022. French Hill joins us, the Republican and banker from Arkansas. He has been a wonderful support to this show in giving us perspective of the South, of Arkansas, and of course of the Republican Party. Congressman Hill, always sport reading the Arkansas Times, and I think of their great editor, Max Brantley, who has skewered you over the last number of days. Let me cut to the chase. The gentlewoman from Wyoming and her father looked pretty lonely out there. Why couldn't a guy like you honor the police, the officers that protected you on January 6th?
Well, Tom, Jonathan, Lisa, great to be with you. Let me start by saying that the very first resolution to honor the Capitol Police after January 6th was offered by Ed Perlmutter of Colorado and myself to honor their bravery. And that's absolutely the fact that everyone, Republican and Democrat, honors the Capitol Police and their amazing work trying to protect us every day in the work we do for democracy. As it relates to last Thursday, the anniversary of January 6th, the House of Representatives was not in session. There was no one here on January 6th.
We've been around this on the block. It wasn't in session. You could have got on a Gulf Stream and showed up. I mean, it's that simple.
Well, Tom, we were doing district work week. We were not notified that there was anything happening on January 6th. Our offices were never invited or notified about any events on January 6th, and I was at home with my constituents doing meetings. I didn't even anticipate there was an event in Washington, D.C. that day.
Congressman, from the past to the present and to the future, today the focus very much in Washington, D.C. and frankly in markets is going to be the CPI report, the latest on inflation, the idea of 7% year-over-year inflation. What's your view on whether this is a negative or a positive as people see wage increases that they haven't seen in decades?
Yes, we are seeing wage increases. I saw Yardini's report where he thinks it's 9.9% estimated year over year. That's a huge wage increase. That's also troubling, though, even though it's covering the inflation we've witnessed of 6.8 to 7% consumer inflation over the last year. That's a sign that maybe wage expectations are increasing. I looked at HR expectations for increases in salary. They're all at 4% or greater yesterday. So I'm afraid we get in this cycle where we increase our inflationary expectations. We see large wage increases. We've had a lot of trouble getting people back to work. Wages are increasing and consumer prices are increasing. That's why I don't believe inflation is transitory.
Congressman, what do you think will be the most effective way to bring it down without torpedoing the economy?
Yeah, it's a careful balance. The Fed always has that concern in their dual mandate of stable pricing and obviously maximum employment and the fiscal situation. We have inflation, in my view, because we have too much fiscal stimulus over the past 2 years, chasing too few goods, and we have supply chain issues, and we have the most accommodative monetary policy in decades, and we should have begun tapering sooner coming out of the pandemic. So I believe some action on all those things is necessary to lower inflationary expectations. Jay Powell now has this responsibility as he gets, in my opinion, confirmed by the Senate for a second term.
Congressman Hill, is Arkansas fully employed?
You know, Tom, here's my view of that. The unemployment rates dropped to a very low level, 4%, and Arkansas is even slightly better than that. And we've recovered much of the job losses from the pandemic. But if you look at on a national basis, there's still 3 million people out there, fewer working than were working before the pandemic in February of 2020. And we have 1.5 jobs open for every person who's unemployed. So I would argue we're not. We don't have job and capacity utilization as high as it could be or should be. And I think people who look for a job are going to find an increasing wage environment and more opportunities as they search this year.
Congressman, always fantastic to get your contribution on this program. Thank you, Congressman French Hill.
Great to be with you. Thanks.
Thank you, sir, from Washington, D.C. The CPI report in front of us, 8:30 Eastern Time. The payrolls report behind us, and that payrolls report surprised a lot of people, Tom, with that 3 handle on unemployment.
Yeah, it's a statistic that, it's fungible, and you can get different opinions on it. I'll go to the Economic Policy Institute, more of a left kind of think tank with some careful analysis why that's not a germane number. Guess what, John? It's what it is. It's like Dow 30,000. It's like Dow 10,000. It just means something to be under 4%.
Hey, Tom, I'm with you on that point about getting under 4%. The Dow stuff, I'm not so sure. I can't relate to that. But I think there is a vision here, 12 months out. Can you imagine a situation where inflation is trending lower and that unemployment still has a 3 handle and the labor market is this robust? That's a pretty good economy, Tom, if we can get there. And that's the soft landing this Federal Reserve is really, really trying very hard to engineer. That's threading the needle for the next 12 to 24 months.
It is threading the needle, but it's based on data dependency. And John, I know nobody wants to hear this. We all love to get out and pontificate, but they're going to go step by step to the data, and that's why 8:30 here on CPI CPI Wednesday is so important.
The issue, though, people have, Lisa, is that we've already got the data. The data's in. In fact, we've had tons of it. Never mind about the data that's still to come. We've had enough now. And the Fed hasn't done enough already.
And not just that, but the data is going to only get messier in the next couple of months because of Omicron, right? I mean, is this going to perhaps juice the inflation rate because of the supply chain disruptions, or will it actually have a drag on them? I mean, the data has been unprecedented, not only in the numbers that we have seen, but the lack of predictability given the backdrop.
John,
Yes,
It's
Tom.
brutal out there. I'm in my own PMQs right now. I mean, people are just crushing me. Check out this tweet, John. I even, for a moment, I thought maybe you wrote this under one of your ghost accounts.
What does it say?
That you got. I mean, Pharaoh TV. Notice how they see you get yourself right out front here. Shecky, Shecky, thank you so much. I do not blame me for not knowing Rafa, is it? After all, when Rafa was born, Tom was already over 60. Thank you. Tom only remembers things that took place before 1960 in the United States of America. John, Longwood Cricket Club, my grandmother, Ken Rosewall, Pancho Gonzalez, and I will never forget the red hair and the energy that Mr. Laver played with.
That last line, Tom, hits close to home, doesn't it? Just a little bit. Just a little bit. From New York.
Thank you so much.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
5,100 on the S&P 500, the year-end call of Julian Emmanuel now at Evercore. We're going to catch up with him in just 2 minutes' time. Your equity market futures are up 0.1% on the S&P. On the Nasdaq, up a little more than 0.1. The data 1 hour away, the estimate 7% CPI in America, a number we haven't seen for 40 years. In the bond market, we look like this, 2s, 10s and 30s. And the relationship between bonds, fixed income, the rates, and the equity market sounds a little like this over at JP Morgan Asset Management with Bob Michael. Bob Michael says that strike on the Fed put is not 2 to 3% lower on the S&P 500, which is the degree of the correction we've had so far on the S&P. He says it's something like 15 to 30% lower on the S&P, Tom, is when he thinks the Federal Reserve would have to step back in. He thinks we need to do some more work on the front end. So guess what? This is what it sounds like for Bob Michael at JP Morgan, Tom. 90 on a 2-year right now, 90 basis points. He thinks the front end of the yield curve starts to compete with what's happening at the long end. He wants to sit out the long end, stay in cash, maybe get to the front end of the yield curve, Tom, and look at what happens at the long end of the curve. Will the buyers come in? They have over the last week, but the real test for him, Tom, is to see how that develops over the next few months. And I think it's really interesting. You put that together, the front end competing with the back end, and that story that the Fed put is way, way out there.
And for those younger that do know who Rafa Nadal is, John, what's important here is your 15 to 30% is an 18% Dow Jones bear market. And then what we get is excesses off that. That's how you wander out to the 20 level or the negative 30% level.
I know for a fact that you know who Rafa is. You knew that already. Finish on this. Cable, sterling. And if you're on radio, you miss the smile. It's a beautiful thing. It's TK's, not mine.
My annual smile. Get over it. It's January.
Unchanged. The Prime Minister faces some questioning in the UK. Some brutal questioning about his activities going back to May 2020. That drama, that saga continues. Sterling basically unchanged at 136. That's the cross-asset price action. Let's get you some single names, some moves, and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Of course, a lot of hay being made about the rebound that we saw yesterday in tech shares. Of course, you did have the Nasdaq up about 1.5% here. But despite some of the breadth that appears to be shown on the surface level, when you dig down deeper, you had a lot of names that sort of sat out that rally, including Netflix and Tesla. Microsoft was only up about 0.2% yesterday. It's up about 0.3% here in the pre-market. But remember, it's basically been flat to down now for basically the last 8 or 9 sessions here. So you're not really seeing a huge bump up in some of those names. And this largely has to do with concerns about valuation. You did get a couple sell-side analysts today, including over at BMO and at Morgan Stanley, defending Microsoft, saying that when you look at the valuation, it's actually way more attractive than some of the other tech names out there. Yeah, Tom, and then you have PayPal, which had a phenomenal day yesterday, was up 5%, and then today you had a couple analysts come out and actually downgrade the stock to hold, saying valuations may be a little bit too strong, and those shares now down 2% in the pre-market. And Tom, I know you've been loading up here a lot of those Chinese tech stocks. They've actually been having a phenomenal day. They're up higher here in the pre-market.
You just had the close come up. What are you doing? You're getting to be like Pharaoh and promoting your other properties?
Yeah, well, that's all. That's the only reason I'm here, Tom.
Okay, that's good.
Yeah, that's Tom. The close every day starts at 2. We go all the way to 5, believe it or not, Tom. It's a little past your bedtime. But you can stay up for that. And look, here's what you missed yesterday, Tom. Biogen. This was big news after the market here, after it closed, the big Alzheimer's drug, a lot of controversy out there. The Medicare health department here in the United States basically saying it's only going to cover the cost of this for a very limited amount of patients here. Some concerns here about the effectiveness of that drug here. A lot of controversies here. We'll see how that shakes out. Lilly down about 4% here as well.
Romain, thank you so much. It is the toughest job on Wall Street. If you can imagine walking into Evercore ISI, and you have to stand at the table with Edward S. Hyman. It's a little circular table, and he's got his research note, coveted on Wall Street for 40 years, and he says, here, Julian Emmanuel, take the black Magnum Sharpie marker and tell me what's important. Newly anointed equity derivatives and quantitative strategist and user of the acclaimed black marker at Evercore ISI, Julian Emmanuel joins us. What was it like your first day with Edward S. Hyman?
Well, you know, you try to play on the same baseball field as Babe Ruth and, you know, learning from the best. And, you know, I've been doing this for a while, but you keep learning in this business. And if we haven't realized that the last couple of years, I don't think we're ever going to realize
He's going to beat the C.J. Lawrence granularity into you. Take the granularity of Edward S. Hyman, his optimism on the American experiment, and fold it into your SPX, I think, above 5,000 call.
So the bottom line is look, we know we're going to have issues with the Fed, whether they're going to do too much or too little. We've got geopolitics, et cetera. But the bottom line is that Ed Hyman sees this economy growing 4.5% in 2022, and that for us translates into 11% earnings growth on the S&P 500, and that's the recipe for higher stock prices. Period.
Julian, do you think the stocks have fully priced in 3 to 4 rate hikes this year?
They have. And if you think about it this morning, right, we're all obsessing over this number that we're going to hear at 8:30, 7% or whatever. But the fact is we've been obsessing over it for a week. It is in the market.
Okay, so what would it take to surprise the market? What would it take with respect to a Fed approach that could potentially disrupt the rally that you and so many other equity strategists out there see?
Sure. So again, to be very clear, this rally this year is going to be unlike last year. It's going to be volatile. You look at the first 2 days of this week, abject terror Monday morning that no one was ever going to bid for a tech stock again, and then the market turns around. We're going to see that all year. If the Fed tells us later this month that they're going to end QE in January and hints that you could get the start of balance sheet roll-off sooner rather than later, in March or certainly in the first half, those are the kinds of things that could get the market rethinking if the view is that the Fed is going to be more aggressive than expected.
Julian, the team here at Bloomberg, as you know, wrote a wonderful profile piece on you with your new seat at Evercore. And one of the things they picked up on is just one of the great calls you made over the last several years, which is retail participation. Now, Julian, that's been a big factor in some of the price action we've seen over the last couple of years. And I just wonder how you think that develops in 22.
So when you look at the long term, whether it's a function of the baby boom generation estimated to pass on in the neighborhood of 68 trillion to the generations below over the next decade plus, or you think about it in terms of the fact that despite the fact that real yields have climbed drastically over the last week and a half, we're still negative. The desire, the need, the viewpoint that if you're someone who's got a 40-year investing horizon, should be overweight equities, that's what's going to carry us through. There's going to be times, because leverage is still very high in the system, where it won't feel that way, but the big picture is equity investing is a multi-year phenomenon, if not longer.
Julian, the caricature, though, of the new retail investor is one with a time horizon of 5 minutes buying short-dated call options. Are you saying it's different?
I am saying it's different, John. I mean, there's certainly that cohort, no question about it, and we've seen elevated call option volumes for a year and a half now. But look at the flows into equities over the course of the last year and a half. Those, to us, are sticky, and we think that there's more to come.
Julian, earnings season kicking off on Friday. What's the big sector call for you going into this year?
Well, so we actually think that this is a different year because of the fact that the economy is going to grow as strongly as it is. We like value. It isn't necessarily a function of how it's going to move in earnings. We think that's going to be much more of a stock-specific type of event. But looking at the year as it unfolds, we like financials, we like industrials, and we like healthcare.
The bank's kicking things off this Friday with JP Morgan. Julian, congratulations, and wonderful to see you, buddy. As always, thank you. Julian Manuel there of Evercore ISI with a 5,100 price target on the S&P year end. Just going into earnings season, Tom, the bank's kicking things off this Friday.
I'm glad you mentioned it. It's not as big as CPI Wednesday, but I'm sorry, John, this is a big deal. And I've said this before, maybe I'm wrong, but I think that, maybe this is why we saw the Diamond Media splash earlier this week. They're not going to be embarrassed by their profit, but the fact is, the belief is, they're minting money given and within national struggle.
The price action of the year so far, Lisa, capturing some of that story. The banks have been off to a flyer.
Yeah, a lot of it is because of this idea of possibly a steeper yield curve, possibly higher rates, possibly a balance sheet roll-off that will allow the longer end to rise, but also this belief that lending is picking up, that people are starting to borrow now as people run down their savings account. And actually, John, that's what I'm most interested to hear. How much is the borrowing increasing on the consumer side and the corporate side, since that was the story of last year? There's a lot of money and no one was borrowing it.
And on the business side, I think the interesting part of this, Lisa, and Tom, weigh in on it, the supply chain issues have meant people can't build up inventories. They can't build up the inventories. They've had no need to go and borrow money from the bank. That's been a feature in the bank lending story.
Yeah, we'll see that in the data. I mean, I defer to Lisa. You know, I had to do the grocery shopping yesterday. Vet bills come down with COVID. And John, I'm sorry, where I was, the shelves are stocked. I guess there's other stories out there, like the United Air story.
Whole Foods in Manhattan, Tom. Is that where you were?
that's his ecosystem.
Gucci.
Yeah.
Let me say this. At least up 15% over where
prices
it was.
up, Tom.
Yeah, absolutely.
Yeah, a lot of people are feeling that.
You know, it's not. You know, we're making jokes about it. Forget about it. There's some real serious agony out there about food and energy, and that's with Brent crude. John, looking at the Bloomberg terminal on CPI Wednesday, Brent crude 83.88. That hurts.
This is the hope of the administration, Lisa, that some of these issues they fade through the year. But the positive aspects of what we're seeing in the inflation number, a stronger labour market, that sticks. That's the hope. And I think that hope is the hope that this Federal Reserve chairs as well. That's the needle that Chair Powell's trying to thread right now.
It's such a difficult needle to thread. Actually, energy prices are expected to go down as a component of CPI month over month. If you take a look, based on the price at the pump, rents, they are climbing so quickly. I'm really focused on this, a third of the CPI, John.
If wages are up, you're going to see a little bit more of that too. Equity futures up 6 on the S&P. We're up a little more than 0.1%. Inflation, that is just around the corner. 50 minutes away. Your estimate 7%. From New York City, heard on radio, seen on TV. For our audience worldwide, with Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. This is Bloomberg Surveillance.
With the First Word News, I'm Leanne Gerrans. Let's start here in the UK, where Prime Minister Boris Johnson has apologised for attending a Downing Street garden party during lockdown in May 2020. But in Parliament today, he insisted he thought it was a work event.
With hindsight, I should have sent everyone back inside. I should have found some other way to thank them. And I should have recognised that even if it could be said technically to fall within the guidance, there would be millions and millions of people who simply would not see it that way.
Meanwhile, the leader of the opposition has called for Johnson's resignation. Now, billionaire bond fund manager Jeffrey Gundlach warns that recessionary pressure is building along with inflation. In a webcast, Gundlach said the Fed seems pretty far behind the curve when you consider wage growth. He also said the central bank may only be able to raise rates to just 1.5% before it inflicts economic pain. The latest U.S. inflation numbers are out at 8:30 a.m. New York time. An Omicron outbreak in China is sending the jitters through global supply chains. Manufacturers and shippers are bracing for problems inside the world's biggest trading nation. 2 Chinese cities are now in lockdown and more are facing disruption. Policymakers will have to decide how much to increase restrictions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
You mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
March looks like it does today, and the outlook is similar. And of course, there's uncertainty around that. But if it does, then I would support moving the funds rate up at that meeting and starting to move back from some of the extraordinary accommodation we needed earlier in the pandemic.
A chorus of Fed officials looking at the month of March. Our special thanks to Loretta Mester, the Cleveland Fed president, joining Mike McKee and myself just yesterday. From New York with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market up a tenth on the S&P. Yields higher by almost a basis point on 10s to 174.46. Inflation data 8:30 Eastern Time. Andrew Hollenhorst of Citi looking for a move in March. He just publishes right now, Tom, the next few months of inflation data will be key to determining if the Fed will need to proceed with a more rapid rise in policy rates. The speed, the pace dictated by the data. The data's in that already justifies a start. That's the view from Citi.
I agree with that, and it's 2 and 3 and 4 months to make the trend, not one data point. But today's data point will be something, particularly if it comes in south. Right now on retail and the inflation you're enjoying, Kriti Gupta. Kriti, what do you have?
Well, Tom, it's a new year, but it's the same issues. Essentially, those supply chain constraints. It's not just hitting retail. It's hitting semiconductors, chip makers as well. So for my chart of the day today, I decided to compare the two. Essentially, the supply chain issues you're seeing in the semiconductor space relative to the supply chain issues you're seeing in the retail space, really just measured by a simple ratio chart here. And what you really want to know for our radio audience is that chip makers have been beating retail, especially in the last month or so. A lot of that has to do with simply what the growth outlook is. Chip makers are dealing with, say, building up that capacity. Retailers dealing with labor issues more so than anything. And right now, it's ending up to be that use case for chip makers that's helping them outperform.
Kriti, thanks so much. Going to have to race here just because of the inflation call here coming up in about 35 minutes as well. It is a beautiful and frigid, not full moon in New York City last night. I guess even colder into the weekend. All of that leading to the full moon of January 17th. That brings up the new moon in China, which is the Chinese New Year. And Poonam Goyal, our retailing analyst, knows the year of the tiger is important for American retail. Poonam, what do you have?
Yes, so, we're talking about inflation here, and keep in mind the biggest constraints that we have is transportation costs, wages, as well as production. And heading into the Chinese New Year, that means that factories in China are going to operate at lower capacities. People will be taking vacations. And also you have Omicron to deal with, which means that people are getting sick and they're calling out, and China's zero COVID policy isn't helping here.
Are we willing to pay the new prices for retail? What's the research on how the public responds at the grocery store, on Amazon, or at any other platform?
On the discretionary side and even on the food side, yes, people are paying for them. We saw it over the last 2 months during the holiday when discounts were the lowest I've ever seen in a long time, and consumers were out shopping, whether it be online or in stores. So consumers still feel healthy and they are willing to pay the higher prices for now. I think as we start to see sentiment fall a little more, if it does in the year, we think that could change. But in order for prices to go down, retailers need more supply. And we don't see the supply situation changing anytime soon, at least not before the end of 2Q.
And Poonam, you were talking about China. How much are some of these retailers trying to diversify away from having their supply chains focused in China due to all the disruptions that have been ongoing for several years now?
They have been diversifying from China for many years now, but the thing is China will still account for a bulk of their production because that is where the labor is, that is where the factories are. You can't just pick up the factories overnight or in 6 months' time or a year's time and move them somewhere else. And where are they moving them? They're moving them to Bangladesh, they're moving them to Vietnam, they're moving them to other parts of Asia still, right? So we're still very dependent on the Asian production to get our goods. We don't produce much of what we consume here, at least on the apparel side. More than 90% of what we consume is manufactured out of the country.
Poonam, in about 40 minutes' time, we're going to be talking about the CPI print. We're going to be talking about what's healthy inflation and what's not, and how wages dovetail into this. As John was saying, we're probably going to hear from the administration that this is a good type of cycle where you're seeing wages increase. There is an issue about the labor market share. What are you seeing from retailers in terms of how much they are able and willing to pass along the cost of higher labor to the end prices, creating something of that spiral that some people are worried about?
So higher wages are great for the consumer, and that probably goes to show why they're able to spend more today. But on the retail front, it's a big, big headwind. And retailers so far have not been seen to take up their ticket prices. Rather, they've been curbing their promotions to drive the margin higher. That said, the wage pressure is going to exist for the next several years. It's not going away. And because retail margins at the apparel side are in the mid to high single digits and on the grocery side in low single digit levels, it's going to be very hard for them to improve their profits without taking prices up if inflation continues at the mid to high single digit pace that we've been seeing for the last 2 months.
And now, folks, the fun part of Bloomberg surveillance, where we front run the research of Bloomberg intelligence. Poonam, come on, Amazon, you haven't written in a while. The core theme here is their gross merchandise value. How good does Amazon look to get to $1 trillion, $2 trillion, $18 trillion of gross merchandise value?
Well, we see it getting to $1 trillion for sure. I think the next leg up from there to get to $2 trillion will depend on how well they scale international. You could argue that some of the growth in the U.S. will mature over the next 5, maybe 10 years, but the next leg will really depend on how well they do in India, where there's some challenges, and Europe.
Poonam Gaur, we've got to leave it there. Poonam, thank you. Joining us from Bloomberg Intelligence. If I told you the equity market would be up 27% over a year, Tom, would you guess that Amazon would be up only 2%? Yeah, only 2.38% last year.
Big laggard, John. And, the zeitgeist out there is interesting. First of all, Mr. Bezos going out the door, you really wonder how that folds into it. And also, they're in we talk about wage spiral. They're, by reports, in a real discussion about compensation across all of their different deciles of employment category.
Elisa, this is what people have been talking about as far as that company is concerned. Not every tech company is the same. They face that labor market issue in a big way.
They do. They also gained 76% the year before. So some of it was brought forward as a result of the pandemic and everyone buying everything.
Not suggesting that Amazon has underperformed over a series of years. That's why I implied you wouldn't have guessed that's what it did based on what the equity market did overall.
But it's telling, because how much is this people just already having brought forward the valuations, and how much is this a change to landscape for retailers, not the tech giants? And Amazon increasingly is a retailer, even though it derives a lot of its a lot of its revenues from its cloud business.
2nd of February, we get earnings from Amazon this Friday, Tom. The big banks kicking things off as they always do with JP Morgan. TK, you've been out front on this week. It's not about CPI for you. It's not about retail sales. It's about those earnings.
Yeah, it is. To me, it's about the earnings and all that. John, I just want to point out at Amazon right now, $24.99. This is perfect for you, John. A Wordle Flex Fit baseball cap.
Okay.
Men's baseball cap.
What does it look like? What color is it?
Hashtag black with a little bit of Wordle. It looks good with Celine. I think this really could go.
What you say? It's just a hashtag Wordle on a cap.
Yeah,
that's all it is.
on a cap. That's all it is.
And it's in black.
Is this real?
Yeah. Yeah.
Would you like one? You want the cap
you
too?
want to know what's real? The letter S is in the correct position.
Lisa sits here daily from 6 to 9 just thinking, is this real?
The key is in the correct position.
Is this happening?
Surveillance Wordle.
Is this happening?
Did I wake up today?
Do I have to come in tomorrow? Futures up a 10th. Inflation data 35 minutes away. On radio, on TV, this is Bloomberg.
Wonder how all that chocolate makes it to the supermarkets in time for Christmas? I'm James Walcock, and I got really curious how chocolate makes its way to the supermarkets every Christmas. So I came here to Nestle's distribution centre to find out how it works. Almost 120 lorries come here every day, and they drop off coffee, chocolate, Kit Kats, Toffee Crisp, you name it. If it's made by Nestle, it will come through here, and it will get sorted by machines who will then load it onto a monorail that runs right up and down the facility. Automated cranes, like this one coming in behind me now, then load all of the chocolate, storage, all of Nestle's goods into this big warehouse. It can hold up to 100,000 crates. And then after it's been sorted and stored, sometimes for months, it will then end up over here, where then lorries will then take it out to supermarkets up and down the country. You can see the entire process is done without people. Goods can come and leave, sometimes without ever touching human hands. It's one of the largest automated centres in the UK, and it opened during COVID. And this Xmas is its first big test, and so far, it looks like things are going well.
Actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
It's important that the Fed has pivoted and changed direction, and the market's handling that quite well.
This repricing still has a lot of room to go.
We do think Omicron is going to impact earnings to some extent.
In the near term, I actually think the market has legs to go higher.
It's a rapidly aging cycle. We'll see if it ages well or if it ages poorly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A 40-year high for inflation. Will it be 7% or higher? It is the item of the hour at 8:30 in 30 minutes. A report on the nation's price change. John, as Lisa mentioned earlier, part of that is rent. Part of that is real estate.
30 minutes away. Will it reinforce the Fed's new pivot? It's likely to, Tom. Most people expecting them to make a move in March. How data dependent are they between now and then? How bad does the data need to be on the output side of things for them to back away? And for corporations, Tom, you've talked about it time and time again over the last 12 months. Can they keep adapting? Can they insulate those margins, expand them even in some places in the same way they did last year?
And what's so important here, John, we're going to look at the financial parts of this and, of course, the market reaction at 8:31. But, John, it comes down to basics that we are guilty of ignoring every day. Chicken in the last year from $1.13 out to $1.80 a pound. That's the granularity of this report this morning.
People are feeling it, and that's the problem, Tom. When you look at the labor market, things are tightening up, wages are decent. In any other year apart from the last couple of years, because wage growth in America in real terms is still negative with headline inflation, Tom, at 7%.
Lisa, can wages keep up within all your reading? And you were very strong this morning on Twitter, Lisa, with what's going on. Can wages keep up with inflation?
You know, right now people are saying that that is what is leading wages higher, that people are leaving their jobs, and when they start to get another one, they say, well, my grocery bill has gone up this much, so my salary should too, and that is leading some of the wage gains. How much does that persist? So some people say we expect to see higher wages, but you asked the question, Tom, are we going to see labor's share of profits actually increase in this? And that still remains to be seen.
That's the social aspect. Let's go back over to the financial aspect. And John, it's the market reaction. What would you suggest?
Front end, Tom, pinned at 90 basis points. That's what HSBC would suggest. Let's talk about what the long end's been up to. Through 180 briefly, back down to 174. And I think Sebastian Page at T. Rowe Price put it correctly a little bit earlier on this morning, Tom. Where does the hawkish surprise come from with a market now geared up for 4 hikes this year and some balance sheet reduction in the mix too?
And that gap from 7.2% now to 6.8%, just as what ifs for the report here in 25 minutes. John, what's fascinating to me is a gallon of gas, this is AAA unleaded, is 13 cents under the peak of autumn. How does Washington react to a 7.2% reading?
What can they do about it, Tom? I caught up with the administration yesterday evening, spoke to a source within the administration. They hadn't seen the number just yet, Tom. One thing they were keen to point out, though, look at the positive trends in the labor market. We think that's going to be sticky through the year ahead. What we don't think will be sticky is the goods price inflation of the last 12 months. They hope that fades for the year ahead. And I think that's economic nirvana, not just for the administration, but for the Fed chair as well. That's threading the needle. Can we keep this labor market pressure going nicely so that we keep wages bubbling away, Tom? And can we fade that goods inflation story of the last 12 months? If that's the case, that's a pretty healthy situation. That is not what we have at the moment.
We're going to address this and fold into the equity market, including Mr. Diamond's optimism seen yesterday in a number of interviews. But right now, John, I got to touch on the data here. John, I'm going to touch with the easy one. Oil, $84 Brent crude, really touching out near that $86 recent high.
WTI pushing 82, Tom, at 81.53. Call it 54, at 0.4%. Yields unchanged at 173.93, and we're basically unchanged everywhere else. On euro dollar at 113.65, on futures on the S&P up a little more than a tenth, and Nasdaq 100 futures at the moment, Tom, at 40, up 0.25%.
Great lineup of guests to brief you before this inflation report and afterwards as well. I note the VIX in 18.17. One of the great features of Alicia Levine is the broad education that says, how do you address equities at any given point? Head of Equities and Capital Market Advisory at BNY Mellon. Ms. Levine joins us this morning. Alicia, what matters right now?
Well, that number at 8:30 matters right now. But to your comments earlier, a lot of the expectation for a hot print is already priced into the market. The market did a lot of work in the first 6 trading days of 2022 in terms of pricing in a more hawkish Fed. So in some sense, the risk is to the other side here over the next few weeks as data come in and as we get earnings that help stabilize markets here. So that's what matters. Look, the most hawkish we could get from this point in terms of Wall Street expectations is a roll-off as QT in March. That's about the worst you could possibly do in terms of the market, and we don't think we're there. We don't think the data is going to support that. We think that the message that's been sent by the Fed and pretty much consensus has already gotten the market to do the work. So we think the risk is on the other side from here. That doesn't mean it's going to be a terrifically easy year. It's going to be a grind of a year, but we do think you wind up positive on the S&P by the end of the year.
Alicia, we talked about this a lot over the last 12 months. The last 12 months wasn't about the Fed. It was about margins and earnings in corporate America. Tom talked about it a million times. Corporate America adapted, kept adapting. Going into 2022, is it all about the Fed? Is that the one single issue for this equity market?
So the theme of the equity market this year is going to be earnings, right? Because our multiples are going to get slightly more compressed from here, and so earnings are going to have to drive the market here. We do think some sectors of the S&P can earn right through this. For instance, we think the focus in 2022, moving away from consumer-led growth really towards CapEx in 2022 and 2023, as those supply chains get reshored and as companies move towards, instead of just in time, it's just in case. And so you'll have a growth spurt here. We see C&I loans starting to grow in the banks at the end of December. So we think industrials can do well, financials should do well in a rate rising environment. And ultimately, we think those profitable tech companies will still do well starting in the middle of the year as growth slows naturally. We're not talking about a slowdown. We're talking about a slower growth rate.
Talk to me about the banks, Alicia. Up 10% year to date. You mentioned how much work we've done in the early part of 22. Up 10%. That's a lot of work for the banks. Where in the financials do you like? What kind of bank do you want to own?
So I think you want to own the banks that lend, because we see that corporate loans are actually increasing, CapEx loans are increasing. Consumers, for the most part, have spent down the extra savings that they had. So we see credit card debt increasing. And so the banks that lend should do relatively better. And if you look at history, the first couple of rate hikes tend to correlate with bank outperformance, with financial outperformance. So we think you have some runway here, definitely for the first 6 months. It's been very hard to project further than that. Because the recovery hasn't been linear, because the virus hasn't been linear, and to your point about all the projections being wrong, this thing is not linear. But I feel comfortable saying for the first half of the year, we do think financials can outperform even from here. Do you wait a couple of days for them to come off a little bit? Of course you do. You never want to just buy the spike. But fundamentally, we think the earnings power are coming through. And again, it's earnings, right? Who's going to earn and who's going to beat earnings? And we think the financials will do it.
Alicia, a lot of people have also been looking more broadly at the cyclicals, like you said, and all of these other stocks, the value stocks that haven't gotten as loved. Where do smaller companies, where does the Russell 2000 fit into this at a time when they may have a harder time adapting to a higher wage, higher inflation regime?
Yeah, look, I think it's tough. I mean, the latest small business report, over 50% of firms said they were going to increase wages and increase prices. So, small businesses can react more quickly to the real economy and to the conditions they're in. But I think there's a pain there. There's a pain trade there, and I think some of the smaller companies will have a harder time dealing with input costs that are high. That's higher. I think the real risk here is really the labor market, the supply of labor. It's a tight labor market. In the conventional sense of how we look at it, 3.9% unemployment, that's the number we all remember, not the number of jobs added. It's the unemployment rate. That's a great number, but ultimately we're still missing 4 million people that were in the jobs market 2 years ago, 3 million of which are either women or over 55s, and that's a health issue, right? So if this thing is not linear, you can't project it.
Alicia, very quickly here, and on radio it should be noted that she has a 7,000 or maybe it's 70,000 piece Lego Millennium Falcon behind her in her living room. Alicia, you know that the galactic economy never was the same after hyperdrive came in. Hyperdrive came in like on the Millennium Falcon, and it changed the economics of Star Wars. Are we misjudging the technological innovation of the next couple years?
Yes, yes. That's why, that's why we still believe in tech. I don't think tech is going to have a great quarter here, because this is the quarter that the bond market and the equity market has to do the rotation and do the work of pricing in the tightening that's coming forward. But ultimately, digitization and CapEx means investment in tech. And so ultimately, that has to be part of the portfolio, and we're overweighted for that reason. Is it going to be a tough quarter? Yes, it'll be tough, but that's why you will own energy and financials and industrials that are all going to benefit from that same CapEx cycle.
Oh, Alicia, control room debate now. Is it a Millennium Falcon or an Imperial Cruiser? What is it?
So that behind my shoulder is an Imperial Star Destroyer.
There we go.
There we go.
I knew
All
it.
about the facts here, Alicia. All about the facts. Alicia, thank you. Alicia Levine of BNY Mellon, thank you very much. Javier Blas this morning had a tweet on companies adapting, Tom. This one from the Domino's CEO. The first of the company's changes to its national offers will be to make the $7.99 carry-out offer into an online-only deal and to reduce the number of chicken wings per order to 8 from 10. This is the shrinkflation dynamic, Tom.
It's there. It always is.
Keep the price the same.
Number of tomatoes in the can.
Give them less. Futures up 5 on the S&P, up a tenth of 1%.
The surveillance mantra.
We're just giving them less. 8:30 Eastern, inflation in America from New York.
Really?
This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The U.S. Consumer Price Index coming out in a few minutes is expected to show that inflation climbed to 7% in December. That would be the most since 1982. That will keep markets' attention on a Fed rate liftoff as soon as a March policy makers meeting. The CPI data is released at 8:30 a.m. New York time. Now, here in the UK, Prime Minister Boris Johnson has apologised for attending a Downing Street garden party during lockdown in May 2020. But in Parliament today, he insisted he thought it was a work event.
With hindsight, I should have sent everyone back inside. I should have found some other way to thank them. And I should have recognised that even if it could be said technically to fall within the guidance, there would be millions and millions of people who simply would not see it that way.
Meanwhile, the leader of the opposition party has called for the resignation of Johnson. The White House is moving to prevent future shortages of coronavirus tests. The administration wants to ensure they continue to be produced in large numbers even after the Omicron variant recedes and demand does fall. Americans are waiting in long lines to get tested. That leads to frustration that poses a political risk for President Biden. Morgan Stanley will raise annual bonuses for its best performing staff by more than 20%, reports say. According to Reuters, bankers in the equity underwriting and M&A advisory business are expected to get the biggest raises. Morgan Stanley is not commenting. Global news 24 hours a day, on air and on Bloomberg Quick Take. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There are a lot of EVs coming to market, and I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share will expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
From New York City for our audience worldwide on TV and radio, alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, counting you down to inflation data in America, about 12 minutes away. In your equity market, up 7 on the S&P, up a little more than 1/10% on the Nasdaq 100. We advanced 42, up 1/3 of 1%. Yields unchanged at 173.22. But as Alicia Levine of BNY Mellon said about 10 minutes ago, we've done a lot of work already this year.
Yeah.
The 10-year yield up by more than 20 basis points. I think around about 22 basis points at the moment, Tom. Yields up. We've priced in more hikes. And to her point, it's going to take a lot to surprise this market at 8:30 Eastern. The estimate at the moment is 7%.
Yeah, I thought she had an estimate of growthiness that was in there, like what we heard from Julian Emmanuel at Evercore ISA, and frankly, John, what we heard from James Dimon over the last 2 days at JP Morgan. These people are betting on growth.
Looking for a better economy, Tom, in the year ahead. That seems to be the bottom line.
Because we're up against 8:30, I want to get this housekeeping out of the way. We do have a winner in surveillance Wordle. I want to be very quickly on this. Anne-Marie, she's like gifted, John. I don't know what Anne-Marie's doing, but she just nails it time and again. Today's Wordle is Spurs.
It's Spurs.
It's Spurs because they play Chelsea, and I'll have to get up from the surveillance nap.
Is that your word of the day, Tom, and not the Wordle word?
No, that's like surveillance Wordle. It's like different than Wordle.
Okay, just to confirm, just in case anyone wastes a chance at getting the correct
That's true.
word.
Joining us right now, Ira Jersey, and we usually would quiz him on Chelsea Spurs, but because of the moment here at 8:19 in this important inflation report, how does a bond guy and a short-term paper guy like you, Ira, how do you interpret or use the data we will see in 10 minutes?
Yeah, so it's going to be the internal data. So a lot, if we get anywhere between 6.5% and 7.5%, I agree that the market's probably not going to react that crazy. But some of the internal data is really important, particularly what I'm going to be focusing on is the services component. So you basically have 4 big components of CPI, with services being the one that tends to be the most sticky. So that's the one where if we're going to see 4.5% inflation over the next couple of years, that's the sector that has to see growth in order for that to occur. Last month it fell a little bit in November compared to October, but in December if it comes in again at 0.3, then that's a good sign that we will have inflation moderating over the course of the year.
How messy is this data, Ira, given the fact that we're still dealing with Omicron, we're still dealing with certain restrictions? This is not necessarily a clean read on a recovery in the services sector.
Well, unfortunately, that's the world we live in these days, right, Lisa, is that we don't know exactly what the trends are going to be because we don't know how Omicron is necessarily going to affect lockdowns and the like. But some of the things that we do know that oil prices have not gone up a lot over the last couple of months. They've kind of hovered, 70 to 80 for the most part. So we have a pretty good idea about where energy is going to be. We have a pretty good idea where food's going to be. It's some goods prices and in particular services prices that are going to be driving a lot of these reports. And of course, services are affected pretty significantly by lockdowns and also, labor participation and what wages are doing. So, and we know that aggregate labor income has actually stabilized quite significantly, which is a little bit surprising given how tight the labor market is. And since that's the case, then we might see services prices kind of stabilize near these levels at 0.3% a month, which means that you'd have inflation by the end of the year under 4%. All else being equal.
Ira, when you start to look at the specific components, there is a question about what the Fed can do to affect any of them. How much can they affect supply chain disruptions? How much can they affect necessarily services sector inflation as a result of some of those input costs? Is there a component of the inflation read that will catch the Fed's attention more than any other?
Yeah, I think it's going to be core goods and core services prices, right? So the Fed really can affect demand, particularly in the goods sector, right? So if they raise interest rates, people will theoretically borrow less, or it becomes more expensive for them to buy a good even at a higher price. So that will crimp demand, right? So the Fed, remember, really has a significant impact on the demand side of the economy, not as much on the supply side, which is one of the reasons why it's a little bit it's really a tough situation for them, because do they wind up crimping demand because of these supply side issues, and will the supply side issues work themselves out if there is less demand? So it's really a conundrum for the Fed at this point, because it's not, we don't see a demand driven inflation in many sectors.
Ira, Steve Major has been dead on at HSBC about lower for longer on rates. He reaffirms that today, particularly in the 2-year space, under a 1% call out. Do you have a framework of getting to a positive real yield? I mean, within the mix that you do at Bloomberg Intelligence, can you say a positive real yield when?
Yeah, so it depends on where you're looking along the curve, but I think if we are looking at that short end, so call it Fed funds out to 2 years, then we do think that by 2024 we could have a zero real yield, so not very positive, maybe a couple of basis points, but we think that the real yield in the front end of the curve could be positive by the end of this cycle. The longer end is a little bit dicier, because you have significant increases in inflation expectations. So when you look at the market, right, so you look at how tips are trading, there's a lot of people still piling money into inflation-related product like ETFs and mutual funds, and that's keeping real yields significantly lower than they probably should be. In fact, our model shows fair value for 10-year tips at negative 50 basis points. We're now at negative 85. So that's a 35 basis point richness in that part of the curve. And I think that's in large part because of what retail is doing. And in part as well, as we see the Fed taper, you've seen a significant increase in real yields over the course of the year. But it's still not there, not anywhere near where they probably should be given the economic environment.
Ira, thank you, buddy. Good to see you, sir. As always, Ira Jersey going into this inflation print, leading the coverage, as always, on the economic data in America. It's Mike McKee. Mike McKee, a quick final word from you before this print. The median estimate, 7%.
We love round numbers. I mean, we were at 6.8% last month, and it's not a significant change to get to 7. But it will be a political issue for the Fed chair, who has to live up to his promise that he made yesterday that they can bring this in for a soft landing. And it's obviously a political problem for Joe Biden. Interestingly enough, the New York Fed does a survey of consumers every month, and in December, consumers felt that prices were going down for things like gasoline and food. Let's see if that matches up with reality.
Core or headline, which is of greatest value to our listeners and viewers? We're living headline.
We're living headline, and I would say headline because that's the headline that's going to be in the paper that's going to get into people's minds. But Ira Jersey was right. We're going to look at the subcomponents and see what's gaining, what's losing, if anything, and get some idea of where we're going from here.
What's amazing, John, is he'll be just as strong on Retail Friday.
He will be. We'll be teasing that in promo and get straight after the CPI Wednesday.
Thank you.
Tom, the sticker shock of that 7 handle, as Mike points out, if we get it, that's the front page. The difference is only 20 basis points from the previous month. I say only because the difference is much bigger than that.
It is so different than the last time we were at 7%. I can't, the dismal 70s, John, the defeatist attitude of that high inflation was radically different than what we face now.
Breaking down the story for us, Mike McKee, when the number drops in 5 minutes' time. Responding to that, Michael Gapin of Barclays, who thinks this Federal Reserve is ready to go. He's looking for a hike in March. Futures positive 0.33%, yields unchanged on 10s at 173.22. CPI in America, the data up next from New York. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Your economic data seconds away from New York City on TV and radio with Tom Keene and Lisa Abravitz. I'm Jonathan Ferro. Equity futures into this one up 0.2% on the S&P, up a third on the Nasdaq. Yields on a 10-year unchanged at 173 on euro dollar. We go nowhere at 113 with the data. Here is Mike McKee.
Winner today, economists who predicted a 7% year-over-year CPI. That's exactly what we got as the headline CPI rises 0.5% on the month. The core rate goes up 0.6, which pushes that up to 5.5%. That's a tick higher than we had anticipated. And I want to stress a number that we haven't stressed in previous years or even months, but it's getting to be more and more important, and that's real average hourly earnings. The Bureau of Labor Statistics takes the average hourly earnings numbers we get from the employment report and subtracts inflation from that. Real average hourly earnings down 2.4%. So you are 2.4% behind inflation at this point, and that's going to be the political issue for both Joe Biden and for Jay Powell.
Mike, get us the compositional story as well beneath the headline number. I'll just whip through the markets quickly. Futures up 0.2 on the S&P, on the Nasdaq too, up about a third. On the bond market story, yields higher by 0.5 basis point. No big moves here. The front end higher by a couple of basis points, but basically where we were earlier this morning at 90. Tom, when you go through this data, and to Mike McKee's point, this market has been primed for this number for quite a while. This morning, this feels like a bigger political story than it is a market one.
Strongly agree with that. What you look at, John, is the so-called integrand, the space, the area underneath the zero line. And Michael McKee, as you massage the data here, I mean, all this comes down to is a political reality of 2021 is a lot of negative wage integrand there.
Yeah, that's going to be an issue going forward. If the Fed is right and inflation backs off, the question is when will people start to feel that and really notice it? And they'll be looking at things. This comes up every month, like food and energy. And the slightly good news, John and Tom and Lisa, is that food prices on the month rose 0.5%. That's lower than it was in November and October and September. So a little bit of a back off. It's still up 6.3% on the year. So people are going to notice that 6.5% in terms of food at home. Gasoline prices are down by 0.5% in December. But as you've been reporting this morning, oil prices rising again. We'll see what happens with that in the month of January. Gasoline prices on the year up 49.9%. That will get people's attention.
Michael McKee, how much are we seeing that services sector inflation rebound that a lot of people have been expecting as the goods area starts to decelerate a little bit?
Yeah, that's one that flattened out a little bit, Lisa. We saw services, less energy, up 0.3%. It was 0.4 in the month of October, 0.4 in the month of November. And so it's down a little bit, 3.7% on the year. But you look at the headline number, up 7%, and services up 3.7%. A big contribution from goods there, and a lot of that is supply chains. Service industry is less of a supply chain problem because people aren't using them.
Mike, well, one final question here, and not to catch you unawares. OER residences, non-seasonally adjusted up rent and mortgages.
It's about as good as they can figure out how to do for, that's the way the government calculates what it costs to buy a home. And one of the big problems with buying a home is you only do it once every decade or so. So it's not an ongoing thing that changes month to month for most people, and that makes it really hard to come up with a number for it. But we have seen rents been going up. They've been repricing. Everybody got a deal during the pandemic in 2020, and now those leases are up and people are having to pay up.
Right.
And they use that imputed rent to try to get the household number out of it, and so we know home prices are going up, but going up slowly.
Michael McKee, thank you so much. Much more from Mr. McKee through the morning. John, we got to do the data one more time. I've got Brent crude breaking out to a higher level here, getting up to an 84.40 as well. And John, I see the VIX coming in. I'm sorry, John, after what we saw on Monday, a VIX of 17.94 is a big deal.
Not much price action in the bond market, Tom. 10's unchanged at 174, 30's up a single basis point to almost 2.1%. 2 is just south of 90 now, up a single basis point off the back of this. But this is the political story here, Tom. It's been some 40 years. You've got to go back to 1982, the last time we saw a 7-handle. And for many people, it's let's go, let's go. Over on the FOMC, Michael Gapin joins us now, the chief U.S. economist at Barclays. And Mike, you've pointed out, let's go in March. My question would be, what would stop them between now and then?
Well, really not much. I mean, you would need a major shift in terms of, say, an Omicron effect on the economy, a geopolitical event that would somehow disrupt the economy or risk-taking sentiment. But in terms of where the Fed is on their dual mandate, inflation and the labor market, they're basically there. So coming out of the last employment report with the unemployment rate at 3.9, another month of solid employment gains, a 0.6 rise in average hourly earnings, that pretty much meets their bar. So I think in January, at the January meeting at the end of this month, they could very well declare we're at full employment. Yesterday, Powell said we are at or very close to full employment. They've already told us they're there on the inflation side. So I don't really think anything stops them from going in March, except one of these kind of outlier events. I think they're ready.
Michael Gapin, you and I are the only ones that will understand in 1982, eye of the tiger reigned supreme. So inflation's rising up back on the street. Is this the same inflation as 1982?
No. So that was Rocky 3, right?
I think so. Rocky 5.
Yeah. So the 70s and 80s inflation was a multi-decade period of demand exceeding supply, creating wage price spirals, higher inflation expectations. It was very much a demand-driven story, although there were certainly supply shock components to it with the oil market at the time. This is a very different outcome. It's not necessarily from persistently easy policy over previous decades and expansionary fiscal policy. Obviously, we have some of that in the response to the pandemic. We think it's still primarily a pandemic-driven story that is likely to ease over time. And as you mentioned in the last segment, what can the Fed do about that? I think a lot of this risk management positioning is about preventing second round effects, right? Preventing the impulse today from showing up in a lot higher, longer run inflation expectations. So I do think it's a very different inflation. So how the Fed responds to it should be different.
And Michael, what's so important here is just a president and his will to survive. What does President Biden do with 7% inflation?
In part, talk about that you get it. You see it, you get it, you understand the problem. It crimps real incomes. Households are very sensitive to changes in energy prices and food prices. And then you also want to take some steps perhaps to help solve it. Make sure that your Federal Reserve chairman that you're appointing understands the issue and the importance of getting inflation lower. They unlock some of the strategic reserve in terms of oil supplies. There's discussions around do you reverse tariffs on imports from China. So what can you do to help bring inflation down and stabilize the situation? But certainly he has to say, we get it and we understand it and we're taking corrective measures.
How do you get the wrong kind of inflation down while keeping the inflation that they want to see? As we've been hearing from John this morning, the administration perhaps going to be looking much more at the wage increases and how this is possibly a good thing for the worker. Paint a picture of negative 2.4% real year-over-year hourly wages. What does that mean in terms of the wage increases we can expect going forward and the trajectory of economic momentum?
Well, certainly, I think conditions in the labor market are tight. We still have, roughly 4 million people sitting on the sideline. Demand for labor is strong. I suspect labor market conditions will remain robust and average hourly earnings will continue to tick higher. And then you would hope that some of the inflation comes down on the other side. But in the moment, of course, what it means is it bites and it crimps real purchasing power. So disposable income was kind of all the story last year about government transfer payments supporting income. If you start to adjust for inflation now, disposable income the last few months has been ticking lower. So it might feed in to a little less demand. And this is where the Fed's messaging has shifted. It used to be we need accommodative policy to keep labor market momentum going. Now what we need to do is stabilize inflation to keep labor markets going and income and purchasing power elevated. So it has shifted the narrative from the Fed.
Mike, part of that effort is not just rate hikes, it's balance sheet reduction as well. Informing the analysis at the moment is just the Fed speak. Where on earth is this going? We have a balance sheet pushing $9 trillion. We're all trying to work out the month-on-month reduction, Mike. Have you got any idea what that looks like through the back half of this year if they start this summer, what it looks like into next year?
Sure. I think if most of us think the balance sheet runoff is going to start in the second half of the year, we're in July. Powell seemed to say later this year. So if you look at the maturity schedule of the Fed's balance sheet, roughly over the year after that point, you're looking at let's call it about $1 trillion in treasuries running off, and prepay estimates on MBS portfolios will give you somewhere around another $300 billion. So I think you could have at least half of that, $750 billion, maybe up to $1 trillion in terms of how much the Fed wants to take out of the balance sheet over kind of the first 12 months. So let's call it 60 to 80 billion a month. They may need to ratchet up to that level over time, start with a cap that's lower and move higher. But I do think that they want to get to the balance sheet sooner than later. And with the $1.5 trillion sitting in the reverse repo facility, I think they feel they can do a lot of draining of reserves without having a negative effect on front-end financing conditions. So I think they may try to get a fairly fast pace of runoff in the beginning. And last point, if I can make it, there's about $325 billion in T-bills on the Fed's balance sheet this time. We had almost zero in the last expansion when the Fed was doing this. So you may see different runoff rates for the T-bills and the remainder of the coupon issuance or the coupon holdings that they have. You could get a lot of runoff fairly quickly just by letting T-bills go.
That's a very interesting point. Mike Gapin, thank you. Mike Gapin of Barclays. Your inflation number 7%, widely expected. The sticker shock, it's going to be a political issue. You've got to go back to 1982 to see an inflation print in America this high. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The inflation rate in the US has now hit the highest level in 4 decades. The consumer price index for December was 7% higher than the previous year. That was the most since 1982 and in line with expectations. Energy prices fell last month, but there were rapid increases in food, cars and clothes. Meanwhile, the CEO of the second largest gold miner is skeptical of government's attempts to tame inflation. Mark Bristow of Barrick Gold spoke to Bloomberg at the Future Minerals Forum in Riyadh, Saudi Arabia.
But when inflation arrives, it's difficult to stop. It needs to be dealt with in a robust fashion, and I don't think there's political will around the world to do that.
Bristow also said that cryptocurrency cannot beat gold when it comes to a hedge against inflation. For the first time since 2015, BMW has beaten its rival Mercedes for the luxury car sales crown. Deliveries of BMW rose 9% to a record 2.2 million last year. Meanwhile, Mercedes output fell 5% to 2.1 million after the lack of semiconductors grew worse in the second half. And a teenage security researcher claims that he hacked into more than 25 Teslas in 13 countries in a series of tweets. David Colombo said that a software flaw allowed him to unlock doors and windows, start the cars without keys, and disable their security systems. Colombo says Tesla is now investigating. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The big issue is inflation, which I don't think is transitory. I think it is. It was to be expected given the amount of economic stimulus that went into governments around the world. One way you know this inflation is really going to stick is the wage inflation. You can't take it back after you increase the wage. And so at the end of the day, I think that that tells us a lot.
Melody Hobson of Chicago and Ariel Investments, the co-chief executive officer, and of course many other worthy items for Princeton University and around this nation, a philanthropist, of course I should note, with Bloomberg Philanthropies as well. But there is a different story. It's a story that David Rubenstein dives into, and this is the youngest kid of a single mom in Chicago who, among the struggle of painting apartment walls, said, I want my daughter to go to better schools. Melody, I think more than anyone I know in the game, has excelled, but people have forgotten about her past. Did you explore that with Melody Hobson?
I did. Now, of course, she has not forgotten her past, the youngest of 6 children, and she was frequently finding that her parents or mother was being evicted, and they had to basically worry about where the food was coming from. She got a Princeton degree. She became a co-CEO, as you pointed out, of Ariel Investments, a minority-owned investment firm in Chicago, married George Lucas. Now she's actively involved in philanthropy, but also she's the co-chairman, or the chairman, I should say, of Starbucks, and is the co-CEO of her firm.
I take immense issue with people that say, well, it's George Lucas or whatever, Princeton, ... It's about a character set from her childhood. What did you discuss with her about the best practices she learned enjoying eviction in Chicago?
Well, among other things, she learned how to work hard and study and be very loyal. She joined Ariel right out of college, and she's been there ever since. She's the only person in her class at Princeton who has the same telephone number they had upon graduation. She hasn't changed jobs. The only person in her class, she said, hasn't changed jobs.
David, how is that view from her perspective growing up from a much less beneficial or less wealthy past into where she is now, color her view on how companies should operate themselves, on how they should pay their employees?
Well, she believes that companies need to do a much better job of getting minorities on their board and also minorities in their executive suites, and that's one of her areas of focus. She's also on the J.P. Morgan board, and she, with J.P. Morgan, have been making a major effort to have investments made in minority-owned firms. But she hasn't forgotten her past, although she can go out and see anybody in the world today because she's so well known, and she did this interview with me when she just flew in from a conference in Dubai, got off the plane, cleaned up, and then did the interview. Then she was off to, I think, the West Coast. So she's an incredible person, but she hasn't forgotten her past. Many people who come from poor circumstances, sometimes they forget their past, but she does not. She's very close to her family, and she's also very close to giving back to a lot of parts of Chicago where she's based, in terms of making certain that people there have better chances than maybe she had as a young person.
David, it's a fascinating time to speak with her, especially as we do seem to be at a pivot point in the economy with a changed landscape for inflation. We just got that inflation read, and real wages still negative, deeply so. Some of the most negative reads in real wages year over year going back decades. What's her view on how to invest in such an uncertain economy?
Well, her firm has been what's called a value investment firm, which is to say they look at companies that are not the high-tech, high flyers, but ones that clearly are going to do well when the economy is in reasonable shape or not growing so well. That's what they've been doing for some 20-plus years that she's been there. And her view is you just can't just chase the high flyers. But she does think there are values out there, and she's a very cautious and very careful investor. And she's not somebody who travels around the world and tells people, look, I'm married to George Lucas. Look, I'm very good friends with Bill Bradley. Yeah. She actually does a lot of hard work, and she's very, very knowledgeable about what she's talking about.
Ariel Investments faces the challenges of active management. I remember as clear as a bell in the early 1980s when John Rogers launched this strange experiment. They have to deal in the new financial world. And Mr. Rubenstein, we have to have you comment on new and fresh investment to Citadel Securities, not the hedge fund, but the order flow Robinhood part of it. Please discuss Sequoia Paradigm and how they have chosen to invest in Citadel.
Well, Sequoia is perhaps the leading venture firm in the United States in recent years. They've done extremely well. They have made with another firm, a $1.5 billion investment into the Citadel Securities, a company that was built by a very, very talented person, Ken Griffin. Ken Griffin has run Citadel's hedge fund for a long time. It's about a $43 billion hedge fund. But a separate business, which is extremely profitable, is Citadel Securities, which trades and clears security trading all over the world now.
It's amazing how you finesse this. I'm going to stop the show, folks. David Rubenstein here is dropping the lead line here. Fred Hirschheim came out of Duke University and did Paradigm. What is it like that Duke University could generate a guy like Fred who did Coinbase, did this, and now takes part in Citadel?
Well, I'm sure the development people at Duke will be in touch with him very shortly. But obviously, we're proud to have people like that come from Duke University. Ken Griffin is a graduate of Harvard. He came from modest circumstances, did very well at Harvard, and been trading ever since. And he's become one of the most successful people in the financial service world, for sure.
David, thrilled to have you join us in studio today. David Rubenstein, of course, of Carlisle, and an important interview, Melody Hobson, who's lived at board member, I should mention, for Bloomberg Philanthropies as well. Lisa, the market's move, I'm going to say it's a constructive treatment on what we see off this inflation report.
Yeah, people already had a sense of what to expect, and it seems like the market is taking in stride some of these figures. However, looking under the hood, I am really struck by this inflation report. It is not a food and energy-driven one. The core CPI rising more than expected, with shelter costs rising 0.4% from the prior month after several reads of 0.5%. Basically, rent costs are going up dramatically. Also, autos, a huge driver driver of the increase that we saw in inflation. They are still going up as some of those supply chain disruptions continue to crimp supplies and demand continues to remain hot.
And on the data, we see it with the yield coming in at 1.72% on the 10-year yield. That's a fractional move. We'll take it. NASDAQ up 0.8%. NASDAQ, they're a very good number here, back to almost a 16,000 level as well. Lisa,
Tom,
yeah, please.
I got to say, at what point do we move beyond it's all baked in, right? I mean, there's so much disagreement among many people. Is it all baked in, or do we see something that is potentially a cause for volatility later on?
Come on, Lisa. We like to do storytelling, and we're on a journey here, and we have to have it's all baked in. It is not all baked in, and after you've been wrong 7 times in a row like I have in the markets, you learn that it's not all baked in. The smartest thing I heard today, I can't remember, my brain's frozen. I remember Rafa, but I don't remember who said we need 2, 3, 4 months of inflation data to get a real trend here.
Yeah, the problem is a lot of people saying that the Fed is behind the curve. When you start to see rents increase as much as they have, that's a lagging indicator. It is lagging behind home prices and will continue to increase. How much do wages try to catch up with the pace of inflation as people start to say, hey, I'm basically getting a pay cut if you don't pay me a lot more?
I would link lagging indicator directly into the Morgan Stanley compensation lift that Leanne Gerrans was talking about earlier. It is an eventful day. You must stay with us. We continue to look at the pandemic and pharmaceuticals, a theme for Bloomberg this week. Christoph Weber joins from Takeda. Please stay with us on radio, on television. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Actually given a handbag by my mother when I was about 60, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It is a number we haven't seen for 40 years. It's a number this market's been primed for several months. Your equity market, futures up 24, advancing 0.5% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, inflation in America.
Inflation.
As we think about inflation,
The Fed's in a tough spot. They have a significant inflation problem on their hands.
the
CPI numbers.
this first quarter data won't look fantastic.
We're now looking at a 7-handle. Eye-popping inflation numbers. And
They're going to need to thread the needle here.
They want to appease financial markets.
Convince market players that they're going to control inflation.
On the other hand, you've got the public that's upset about inflation.
Political problem number one for the Biden administration.
The Fed is going to have to walk this very delicate balance.
It has a 7-handle. Joining us now to discuss is Emily Rowland of John Hancock, JP Morgan's Jack Caffrey, and Morgan Stanley's Vishy Tripator. Let's begin with you, Emily, your reaction to the number from 30 minutes ago.
I do think that there was a fear that inflation was going to come in hotter than expected for the month of December, and it essentially met expectations. So you're not seeing a huge reaction from the markets. This is just about the most talked about thing that we ever, discuss these days with clients and investors. So I think there was a lot of anticipation today, and a lot of it's been priced in. If you look at cross-asset performance, commodities have been on a tear. Tips absolutely crushed it last year. The yield on the 2-year treasuries backed up meaningfully to reflect Fed policy. So I think the key question is, for those that are expecting higher inflation readings to really continue throughout the year, will those expectations be met? And our view is that you will see elevated inflation readings for the next few months. Remember, this time last year, inflation was at 1.4%. It was at 1.7% in February and didn't climb above 2% until March of last year. So we think base effects are going to really push inflation readings higher over the next few months. And then we actually see disinflation as those base effects go from basically being your best friend to your worst enemy. As it relates to the Fed, I don't think that there was enough in today's report to stop them from pursuing this more hawkish path that they've laid out.
Vishy, this bond market's done a lot of heavy lifting year to date already. We're not even 2 full weeks into 22. 10-year yields this morning down 2 basis points to 171. Vishy, your response, please.
I think I broadly agree with what Emily just said. I think this expectation that in the first few months of the year we'll see level of inflation go higher. It is in line with that expectation. We do expect that over the course of the year, as the year goes along, we will see some of these inflationary pressures begin to come down, and we'll end the year at a much lower level. And I think from my takeaway from this is it does reinforce the message that we have been getting from the Fed. Including yesterday's testimony by the chair. I think that the inflation is a challenge that they seem to want to address it front and center.
Jack Caffrey, your reaction.
Certainly this has been, as Emily pointed out, one of the most anticipated numbers we've been talking about for quite some time. And certainly base math is going to be a challenge. I think the question is, what is the potential rate of the fade in inflation over the course of this year? And can we create a situation where you can get that number where it might run a bit hot against the Fed's longer term goal of 2%, but how long do we live with a 2.5%, 3.25% inflation rate when we start thinking about what things look like in 2023? And I think that becomes the question. And to what extent does labor start also pushing and saying, I effectively am getting anti-stimulus at this point in time, whether it's rising rents or can I get wage gains, and how does the corporate sector then respond to a potentially more challenging labor market, which is certainly when the Fed pivoted as part of their pivot yesterday, talking about we may be at fullish employment, even if we're not at that academic definition.
And we've got there pretty quickly. It's a number we haven't seen since 1982. Mike McKee, it's been a while.
It's been a while, 1982, and let's take a look at the chart here. It shows you just how long it has been and how high we've gone above the Fed's target. That's the red band there, the 2.5 to 1.5%. They got to do something about that, by the way, John. 1982, this number, when it came out, was just after the Tottenham Hotspurs won the FA Cup. So Tom Keene has a frame of reference there. Let's take a look at some of the breakdown of numbers. And this is the problem for Powell and particularly for Joe Biden. People see these numbers in their daily lives. Food at home up 6.5% on an annual basis. The monthly rate was down just a little bit. Maybe that continues, but take a look at gasoline, natural gas. Both of those have gone up since then. And gasoline, 49.6% over the last year. That gets people's attention. Rents starting to rise up 3.3%. That should push up home prices in the CPI, which account for a third of the CPI. Very slow, and that's going to stick around. And used cars, remember they were falling? Not anymore. Now, the good news, if there is good news from the Fed and for the Fed, is that economists think that this is very close to the peak. We are going to start seeing the inflation rate come down in 2022. We'll watch very closely the next couple of months, but if that follows, then they can say maybe they're getting the job done. And then finally, the other issue, though, is that when you get high inflation, it eats away at what you earn. And if you're earning more money, as we have been lately, you're not getting inflation's benefit out of it. You can see there below zero, we're down by about 2.3% in terms of you're below what you would have been making. Even with a raise.
Mike McKee, thank you, sir. On top of the big story this morning. This could be a big one politically. We'll touch base with Anne-Marie Hordern down in Washington, D.C. in just a moment. For Chairman Powell, he faced down Capitol Hill in the last 24 hours, and he's looking to thread the needle.
We're really just going to be moving over the course of this year to a policy that is closer to normal, but it's a long road to normal from where we are. It really should not have negative effects on the employment market.
Vishy, let's pick up on what Chairman Powell just said. How difficult will it be to thread that needle?
I think there is a wide range of outcomes. So clearly it is a pretty challenging job. But I think where the Fed will be focused on is using two of their tools. They have the monetary policy tool, as in rate hikes. They also have the balance sheet tool. And we think what we will end up seeing is a combination of the usage of both of these tools. We already saw yesterday in the chair indicating that at the current size, the balance sheet is too big, 9 trillion too big. So we do expect that unlike what we saw in the last cycle, where there was a substantial lag between the liftoff and the balance sheet normalization, we think that time gap will be much shorter this year, and therefore we'll see a liftoff. And soon after that, in this year, we will see balance sheet normalization. I think we'll see the deployment of both of these tools substantially in this cycle.
Vishy, give me a little bit more on the balance sheet and get technical if you want to. That's the timeline. I caught up with Mike Gapon of Barclays about 40 minutes ago, and he said a lot of these bond buying purchases have been done at the front end in T-bills. It's a different story this time around. He's looking for close to $1 trillion a year in balance sheet unwind. I'm trying to understand your understanding, Vishy, of where you think the bulk of that balance sheet unwind is going to come from and where on the curve you'll see the most pressure.
Right. So we think that the point where we expect to see more pressure is probably in the 5 to 10 year part of the curve. And I think we should also keep in mind here the balance sheet and the normalization for treasuries and MBS, mortgage-backed securities, would play out quite differently. Because for the treasuries, quantitative tightening, that's what we will see, is not just a quantitative easing with a negative sign. It's actually a little bit less than that. For mortgages, it's actually a little bit more than that. Because unlike treasuries, mortgages were being bought from the dealer, from the secondary market. And therefore, the Fed was also not only buying mortgages, but they were the recipients of the cheapest to deliver mortgages. So as a consequence, the fastest prepaying mortgages are with the Fed. That's what they have been delivered. So they're not buying it actually has a bigger impact than them buying in some ways.
Interesting.
So mortgages more negatively affected. Treasuries, QT is not equal to -1 of put a negative sign on QE.
Got it. On the Treasury side of things, we heard from Bob Michael of JP Morgan Asset Management. He had to say this, and Emily, I want to come to you on this. Without the central bank purchases and with cash now offering some yield, let's see how willing investors are to continue to purchase long-duration government debt at significant negative real yields. Emily, does that resonate with you?
Yeah, it does. I mean, I think the bottom line here is that the cycle is moving incredibly fast. And you talked about the risk that the Fed is taking right now. What they're risking is tightening into a slowing growth environment. And that's pretty unusual. We've been able to have really long cycles because inflation's been incredibly low over the last couple of cycles. And that's changing this time. We talked before about the year-over-year comps as far as inflation goes. Let's talk about the year-over-year comps as far as fiscal stimulus and monetary policy stimulus goes. We had $5 trillion in fiscal stimulus this time last year in the spring. We're not going to get that again. So we see the economic backdrop slowing, the Fed tightening into that, and we actually think that the cycle is aging very quickly because of that. I hate talking about that aging. I was actually around in 1982, which makes me pretty sad, but that's the way we're thinking about these market cycles, and it has key implications for cross-asset performance under the hood. Your question was really around buying longer duration assets. We actually see the 10-year Treasury here chopping around in a sort of a sideways environment, somewhere between 1% and 2% in 2022. We don't see that back up in the 10-year Treasury that many are expecting because of that decelerating growth environment and because of the fact that we're quickly moving towards late cycle here.
Jeff Gundlach picked up on a similar theme. Double Line's Jeff Gundlach saying the following: the Fed seems pretty far behind the curve when you consider wage growth. We're going to be more on recession watch than we have been. Jack, this is the market we're in right now. It's incredibly divided, very polarizing views on either end of the spectrum. Jack, your response to what Jeff's thinking about, what Emily just mentioned, that slowdown, the possibility we hike into one.
Well, certainly we should be getting a slowdown. And from a starting point, from a management perspective, this has been the most robust nominal GDP environment they've operated in for most of their careers. And so I think that's just a very interesting dynamic for them to think about. Cost pressures they really haven't had to deal with. They have wage pressures from their employees they haven't had to deal with. But they also have some pricing power, depending on the individual supply-demand characteristics. When I look at it, I look at a fixed income market, or if I look at the MOVE index, it seems like the bond market traders aren't really sure which way to go. And when I look at the gap between the MOVE index and the equity implied volatility, it really feels like we're going to have issues in the markets. It's more likely to come out of whether investors are willing to take that negative real returns in the fixed income market and how that translates back into the equity market, into the credit markets and the funding market. So ultimately we come back to how twitchy are bond market investors. And if Emily is right, and you put this idea of 3 to 4 rate hikes together, you wind up with a really flat yield curve really quickly. And I think that's going to be that recession watch worry that Jeff Gundlach is talking about.
We'll continue this conversation. Jack Caffrey, Vishy Tripatura and Emily Rowland sticking with us in your market up 0.4% on the S&P with some single names in a pre-market moving. Here's Abby.
Hey there, John. Well, away from the inflation conversation because of the point that you all have been making, much of it priced in, let's take a look at the shares of Biogen, the biotech giant. The stock is plunging right now, down about 9% in the pre-market on the news that the U.S. has limited Medicare coverage of the company's Alzheimer's therapy. Of course, this is the controversial drug approved last year by the FDA. Only patients in clinical trials will have the drug's cost covered. A very unusual move. It is preliminary, but clearly it could limit revenue. Right now, John, the stock in the pre-market on pace for its worst day since March of 2019. That says something, given that it's even worse than the selling in March of 2020.
Abby, thank you. Thank you very much. Coming up on this program, more on that inflation print, grappling with the politics of rising prices.
But when inflation arrives, it's difficult to stop. It needs to be dealt with in a robust fashion, and I don't think there's political will around the world to do that.
More on that conversation still ahead from New York. This is Bloomberg.
When you think about schools in particular and children, where we've seen pediatric hospitalizations actually on the rise amid the spread of this variant, do you think keeping schools open is the right move?
If done well, school is a relatively safe environment for kids. Masking, tests, especially during the surge of cases, I think it is very important for kids to be in school, and I think the chance that school becomes an explosive source of new infections is low with precautions.
10 million cases in just a week. Are we reaching a peak of this wave, considering how quickly it is spreading through the population?
I think at a certain point it really has to slow down, and that's probably within a couple weeks or a few weeks away. And that's, I think, going to be good news. The question is, can we keep hospitalizations down enough during this period so we're not swamping hospitals?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Season is coming.
Q4 earnings are going to be awesome.
Bloomberg is fastest with the numbers and analysis.
Amazon crossing the Bloomberg terminal. Where are investors seeing the weaknesses?
It means profits down the line. Earnings season on Bloomberg Television and Radio.
In terms of where the Fed is on their dual mandate, inflation and the labor market, they're basically there. At the January meeting at the end of this month, they could very well declare we're at full employment. I don't really think anything stops them from going in March, except one of these kind of outlier events.
So we've been waiting for it. We got it. A 7 handle on inflation in America. You've got to go back to 1982 for the last time we saw that number. The White House Press Secretary Jen Psaki was waiting for it. She had this to say: "We expect month-over-month inflation to moderate in the months ahead, and forecasters generally expect the year-over-year measures to come down to more historically typical levels by the end of the year." For more, let's bring in Bloomberg's Anne-Marie Hordern down in D.C. Anne-Marie, if it's not a big market story this morning, it will be a big political one.
Certainly is, Jonathan. It may be priced into the markets, but already my inbox is really blowing up from the right, who are saying what is going on in terms of inflation and questioning the president's policies in regard to what is going on, given what we are seeing in the consumer prices, highest in 39 years. Jonathan, the talking points you're likely going to hear from the White House today are really twofold. One, which we talked about earlier, is the fact that we had a pretty good unemployment report. If you look at the unemployment rate, 3.9%. We are just a smidge off from where we were pre-pandemic. They will likely tout that as something that is good, that is happening in the economy. And second off, they will really outsource the blame, if you will. They are going to talk about the fact that we are seeing higher gasoline prices because of what is going on in the oil market and the likes of OPEC Plus, Saudi Arabia, Russia, what's going on in the UAE. And then also, corporate greed is really a slogan we've heard over the past few months, and they've taken aim recently. When you look at your grocery bill and higher meat prices, they've taken aim at meat processors. So that's likely going to be the talking points, Jonathan. But while the president has very few tools in his arsenal to really combat inflation, there's a great Washington Post article this week that talked about the one tool he has, and that is shaping the Federal Reserve. So if he wanted to immediately address inflation, he can put some inflation hawks on the Federal Reserve. He has 3 open seats. But Jonathan, we still have yet to hear his picks, and we were told we were going to get them before the end of last year.
AMH, we've got to wait. We've got to wait a little bit longer. Anne-Marie down in Washington, D.C. Thank you. I caught up with the administration coming into this print, spoke to a source. They want to focus on the labor market story. They think that development, that positive development, is a little stickier, and these numbers won't be so much. On the labor market, we've got other issues. Take a look at this quote from Scott Kirby of United Airlines. This, for me, quote of the week. "In one day alone at Newark, nearly 1/3 of our workforce called out sick." We've got mounting shortages across this country, cancellations for the airlines as well. I want to get to Emily Rowland, Jack Caffrey, Vishy Tripator. Jack Caffrey, work out this labor market for me. What a difficult time.
Well, I think there's a short-term issue in the labor market, and there's an intermediate-term issue, and then a longer-term issue. The short-term issue is people are sick. And to the extent we look at how rapidly Omicron has spread through the economy, and just over a month ago I was here, and it felt like day one of Omicron in New York City, you're going to have these issues with respect to spot labor shortages around people being sick, being in contact with someone who's been diagnosed as sick, and then being forced to quarantine, even if you shorten, those windows. Intermediate term, I think, is going to be one of how do you encourage people who have to get confident that they can get all the support around them they need to consistently be back in the office, whether that's childcare, concerns around having the schools open being pretty big and pretty important. The longer term issues, I think, come down to, do we have the labor force that we want for the economy that we want? And that's an issue of training. That's an issue of convincing people that certain jobs which have been looked down upon for years are actually really solid paths to the middle class and necessary if you want to have the sort of infrastructure spending cycle that Washington has certainly appropriated money for. Do you have the workforce to have a housing cycle and infrastructure spending simultaneously? That to me remains a pretty big question.
In the short term, we're looking through some of these issues, some of them that you mentioned. Emily, looking at the airlines year to date, we're up 7% on United, on Delta up 5.5%, on American up 6%, JetBlue doing okay. Despite these worker shortages, there's a hope we work through this. I hope we work through this and that inflation print from this morning comes back down. Are you looking through some of this too?
We are. It's like the reopening trade 5.0. How many times can we have this reopening trade? And the start to the year does feel like this sort of risk on bonanza, almost similar to what we saw in the beginning of last year. And, we still do want to embrace risk assets here. We're maintaining our calls into 2021. We're overweight equities. We're looking at areas like U.S. mid and large cap as offense in a portfolio. We want the value factor. We want to pair that with quality. And then we're embracing corporate credit within fixed income. So we think Q1, the economic backdrop remains solid. But we want to be careful about reaching too far for risk here as we head into the back half of the year. As we do see the economic backdrop starting to slow, the leading indicators right now we're at about 10%. Looking at the Conference Board's leading economic indicators, that's one of the key ways that we evaluate where we are in the cycle. We see that coming down later in the year. So we'll start to look at more defensive parts of the market. But for right now, we want to really have some offense. We just would not go too far. It's been like life in the fast lane over the past year, and we would be really thoughtful about really adding on a lot to risk assets and to cyclicality at this stage.
Never mind the past year, the past 2 weeks, 2022 feels like a lifetime already. Vishy, I need to get your view on corporate credit. Emily's saying she's embracing corporate credit, so sit tight. I want to come to you on that in just a couple of minutes' time. Vishy Thirupatur alongside Jack Caffrey and Emily Rowland. Coming up the morning calls and later, stocks breaking their longest losing streak since September. That conversation just around the corner from New York. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
City.
When you're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Alicia Levine of BNY Mellon said it about an hour ago going into the inflation number in America. We've done a lot of work already going into this print. In the equity market, a big churn, some rotation. This morning, positive, up 0.4%. The outperformance on the Nasdaq up 0.75%. Done a lot of work, not just in the equity market, but also the bond market. Switch on the board and get to 10s, up more than 20 basis points on the year so far. Coming out of that inflation number in line with expectations, yields lower by a couple of basis points on 10s to 172. The front end's got interesting over the last couple of weeks too, just short of 90 basis points, through that level briefly a little bit earlier. That's across asset price action. Here are your morning calls. We begin first up with Raymond James. Cutting its price target on PayPal to 229 from 264, maintaining an outperform rating, expecting the stock to stay range-bound in the first half of the year. William Blair upgrading Shopify to outperform from market perform, calling the company's valuation more reasonable amid strong growth. And finally, Wedbush cutting its price target on Biogen to 195 from 249, citing limited Medicare coverage for the firm's Alzheimer's therapy. Coming up, US stocks snapping a 5-day losing streak. More on that conversation still ahead from New York City. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Many people who are minorities don't any longer believe in the American dream. What do you say to these people about whether this country really still exists for the American dream?
The American dream is possible, but it is failing a lot of people because of some of these racial blinders that exist.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
24 seconds away from the opening bell in New York City this morning. Good morning to you all. We've waited 40 years to see a 7 handle on inflation in America. The market's been waiting several months for it. Equity futures up 0.4% on the S&P. Coming out the other side of the print, the Nasdaq outperforms, up 0.7% on the Nasdaq 100. There's the opening bell. Switch on the board and go into the bond market. A move of more than 20 basis points year to date on 10s. Coming out of the print a little bit lower, down 2 to 171.63. In the FX market, the euro reclaiming a 114 handle at 114.11. That currency pair up 0.4%. And crude still flying high. WTI staring down 82 at 81.84, up 0.75%. So around the open then, about 20 seconds in, the S&P 500 advancing 0.1%. The underperformance coming from the more defensive parts of the equity market, utilities and healthcare. Top of the pile, IT, as you might expect, given where Nasdaq futures are. Information technology up by 0.8%. Consumer discretionary up by 0.75%. Citi's Robert Buckland looking for a March dip in this equity market. Here's what he had to say.
The kind of sell-off that we've seen in the first 3, 4, 5 days of this year doesn't count as a dip to me. I'm thinking about something more like 10%. And yeah, fine, that's not a problem. But what we do know is that there is a major hurdle for all financial markets to deal with potentially in March of this year, which is the first upturn in the US rate cycle for 6 years. I suspect that's where perhaps the proper dip will happen.
We started to talk about buying the dip. The first thing that Rob Buckland turned around and said was, where's the dip? Emily Rowland, Jack Caffrey, Vishy Tripator. Emily, let's go there. You've talked about these difficulties in the second half of this year. Why the second half and not what we're facing right now?
Well, look, right now we still have a pretty awesome economic growth backdrop. Manufacturing PMIs in the U.S. around 58. That's very much expansionary. We have a Q4 earnings season that's penciled in to come in at 21% year over year. That's great as far as the fundamental backdrop goes. I think it just gets a little harder into next year. We look at earnings growth for the S&P 500. It's in the mid-single digits for the first 2 quarters of 2022. Still fine, but we're leaving sort of the earnings nirvana of 2021, where we saw 45% earnings growth in the S&P 500. We're also looking at a Fed that's tightening into a slowing growth backdrop. To us, that means you want to stay positioned for now for this accelerating growth backdrop, but you want to look at getting incrementally more defensive as the Fed continues down this path of tightening. There will be a fork in the road where investors need to decide, are they going to keep adding to risk assets here, or are they going to start to look for more defensive parts of the market? And as areas like quality start to cheapen up, as the year progresses, that's where we're going to be looking to add into the end of the year.
Well, many are adding right now at 47.41 on the S&P 500, up 0.6%. On the Nasdaq again, up 0.9%, a lift this morning. Vishy, Jack Caffrey's looking to your world for signs of distress in credit. Vishy, I promised I'd come to you on that. Do you see any signs of that?
Not really. I think if you start looking at, you want to distinguish between fundamentals and technicals. Right? The fundamentals are fine. On the other hand, the credit markets really did benefit a lot from the amount of liquidity that the Fed injected into the markets through quantitative easing. And in fact, last year is a prime example of this. In a year where the total returns were actually negative, we saw pretty massive flows into credit markets. So the part of the credit markets that's actually most sensitive to this part is the investment grade part of the credit market. So fundamentals are fine, and by any metric, liquidity buffers, debt service ratios, all of those things, fundamentals are fine, but the sensitivity is more to this withdrawal of liquidity in the market, and that hits the investment grade market more than it hits the high yield markets. So our thinking is there is still opportunity in credit, and the opportunity is more in high yield versus investment grade. And within high yield, we think there is better opportunity in leveraged loans versus high yield bonds. So where I would think about ordering, sequencing of this is leveraged loans over high yield bonds over investment grade.
And the rate story backing up that story too. Jack Caffrey, how much comfort does that bring you?
Well, I would clarify what I had said in that when I look to fixed income, I don't think we have a credit cycle that we have to worry about in terms of distress. I just do want to keep seeing credit investors still happily taking down the size of credit offerings that we've seen, or corporate credit offerings that we've seen over the past year and a half. that appetite to continue taking risk, I think, in credit will be, I think, telling and telling for the equity market. But coming back to this, I do think in this environment of decelerating growth and possibly decelerating inflation, I think investors are going to feel, looking at much tougher comparisons, I think they are going to start focusing a little less on deeply cyclical ideas. We talked about the airlines a few minutes ago, and start thinking more about those businesses that have quality, have some ability to control their pricing, perhaps because of what they offer uniquely rather than necessarily relying on short-term supply-demand dynamics. And I think that will become what investors can own for the next several years rather than for the next several months.
The other question,
emphasizing quality. Sorry.
The other question I hear a lot, Jack, and just to jump in because I wanted to get there, and I'm being a bit unfair here because I'm going to quote your colleague, Bob Michael at JP Morgan Asset Management, is if this market gets into trouble, when will the Fed back off and what is trouble? And Bob said we disagree about where this Fed put is. It's not 2 to 3%. He thinks it's 15 to 30% lower, given the dynamic we're seeing in the market at the moment. Now, obviously at JP Morgan Asset Management, everyone has their own view on things. We have different portfolio managers, Jack, so you're allowed to take a different view on this. I just wonder from your perspective personally, what you think that Fed put looks like with this backdrop we have at the moment with a 7 handle on CPI.
It's probably going to have a much lower strike price than it's had over the past several years. And I think they can look to a much more robust growth environment than they had in the last cycle. The last cycle was characterized by what felt like the terrible twos that ultimately became the terrific twos and created non-inflationary growth. If you have an economy that can post 4.5% growth in the real economy, I think ultimately that gives the Fed a little bit more wiggle room around sell-offs. And are sell-offs at the market level, or are they more vertical level? We've certainly seen a massive sell-off, say, in high-growth software, and that certainly is not changing any bits of the Fed's commentary. So I think the characterization of a sell-off before actually seeing it is hard to speak to, but I do think that you're not going to have the rush to remain calm sort of speeches that we've gotten out of the Fed over the last several years because the operating environment gives them more flexibility.
Jack Caffrey, well put. So divided on that debate, though, right now for a lot of people I know, and that really shapes your view going out 12 months at the moment. About 7 minutes into the session, equities up 1/3 of 1%, the Nasdaq up 0.8. Yesterday, snapping a 5-day losing streak. Katie Lyons, this market coming out of that inflation print, doing okay.
Yeah, and continuing the rebound we saw taking shape yesterday, or really Monday when it comes to the NASDAQ 100, the big tech rebound in particular is what I want to focus on because we came in Monday off of the worst week for the NASDAQ 100, going all the way back to February of last year. The index fell as much as 2.7% before closing the day in positive territory, and those gains have continued in the next 2 sessions. Right now, we're up more than 5% from the lows of the week, and what has really seen the rotation we had seen at the start of the year turning back the other way in that when you look at this chart on GTV Go, we're looking at the NASDAQ 100 index's performance, which is obviously very tech heavy relative to the S&P 500 value index, basically expensive stocks versus cheaper ones. And what we have seen is 2 back-to-back days, now 3 of tech outperforming, which followed, of course, value leading 8 of the 9 days prior to Monday. That's why there's a lot of red downward pointing bars on the right-hand side of that chart. Now, the reason why this is, John, well, you can probably look to the bond market for that answer because, of course, we saw a massive move in the first trading week of the year, the 10-year yield moving up 25 basis points over just a 5-day period. That has calmed down a lot. And of course, we're seeing yields coming in today off the back of that CPI print. So 1.72 or so % on the 10-year and moderating from where we were at the end of last week, maybe a little bit easier for investors in some of those high multiple stocks to swallow.
Katie, thank you. The big banks, the big winner off the bond market story that Katie's been talking about, up almost 10% year to date. On Friday, we kick off earnings season with JP Morgan. BNY Mellon's Alicia Levine weighing in.
The theme of the equity market this year is going to be earnings. I feel comfortable saying for the first half of the year, we do think financials can outperform. You want to own the banks that lend because we see that corporate loans are actually increasing, CapEx loans are increasing. Consumers, for the most part, have spent down the extra savings that they had. So we see credit card debt increasing. And so the banks that lend should do relatively better.
On the story, here's Abby.
An interesting point Alicia Levine is making on banks and lending. We'll get to that in a moment, but they do kick off. The earnings season for big banks kicks off on Friday with JP Morgan along with Citigroup and Wells Fargo. A little bit unusual perhaps on a Friday ahead of a long holiday weekend. Next Wednesday, we will have Goldman Report, and then on Tuesday, Goldman reports, and on Wednesday, Bank of America and Morgan Stanley report. Now, relative to net income, JP Morgan is expected to lead the pack, nearly $9 billion in net income. That represents 30% year-over-year growth. Bank of America is expected to come in closer to $6.4 billion, and then the rest of the pack somewhere between $3.2 and $4.2 billion. Now, on the year, as you were mentioning, John, the banks are up in a huge way. Today, a bit mixed, even down. That may have to do with Jefferies. Jefferies reported today, sometimes seen as a harbinger of what's to come at their larger rivals. Not a great quarter. Revenues down on a year-over-year basis. Investment banking up just 5%. Capital markets fell 30% on fixed income. However, that potential bright spot that Alicia Levine was speaking about, the big money center banks, loan growth. The Fed data does point to strong growth, up 3.5% at the end of December. So that could help out those banks. On the other hand, John, of course, bringing in the wage conversation, everybody will be watching wage inflation and expenses for these big banks. How much will they have to pay up to keep the big talent?
Abby, thank you. A final word now on the earnings. Looking ahead with Emily Rowland, Jack Caffrey and Vishy Tirupatur. Emily, first to you, a final word, please, on the earnings to come.
Yeah, as I mentioned, Q4 earnings estimates up over 20% is what we have penciled in. That should be great. Actually, financials, though, the only sector expected to see slightly negative earnings growth in Q4. Certainly, we do agree with Alicia that loan growth should be supportive of the banks. We just don't see those organic drivers that should help the sector as much as we do in areas like technology into next year. So we want to own those sectors that have great balance sheets, good return on equity, ability to maintain margins, and ability to grow organically, even as the economic backdrop starts to normalize into this year.
Jack Caffrey.
I think that the key issue is that we're seeing really the end of the easy comps, the easy comparisons on the earning front, and ultimately that shifts your attention towards businesses that have more control over their destiny rather than less. And I think to come back to a theme that we talked about a bit earlier, the idea that there is going to be more pressure, more commentary out of Washington in terms of corporate greed, I think that actually is going to put a little bit more pressure on the idea of companies being able to grow inorganically. And so that emphasis shifts back to companies much more control of their destiny, either through innovation, their own designs, or the sale of a particularly unique product rather than I can go out and buy capacity in the current environment.
Very interesting point. Vishy Tirupatur, final words, sir.
So let me invoke my equity strategy colleague, Michael Wilson, on this. He expects to see earnings growth to be pretty solid. The bigger challenge for the market is not in terms of the earnings growth, but in terms of the PE multiples. So a strong earnings growth through the year, but a much more challenged environment for PEs, PE ratios coming down, and that is the rationale for Mike Wilson to be less than constructive on equities.
The 4,400 call at Morgan Stanley. Vishy, awesome as always. Great to catch up with you, sir. Vishy Tirupatur, Jack Caffrey, Emily Rowland, thank you to all three of you. Your equity market up 1/3% on the S&P. On the NASDAQ up 0.6%. Crude doing nicely. WTI 82.30. Coming up, crude prices climbing to a 2-month high.
Events outside of the core fundamentals of oil impacting crude this year is going to be hugely important.
That conversation up next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We still think triple-digit oil is within the works heading into the second quarter. We see demand recovering quite meaningfully, and one thing we've been noting for a while is that OPEC plus supply, is likely going to start leveling off in the next 2 months.
Oil climbing to its highest level since November, with demand making a comeback. Oman's oil minister expecting OPEC supply hikes to remain conservative, saying the following: demand is increasing and we want to make sure that the market is not overheating. We don't want to see $100 a barrel. The world is not ready for that. Joining us now is Bloomberg's Julian Lee. Julian, what is the case for triple-digit crude?
We are already seeing a much tighter market than people were forecasting in the first quarter. The U.S. Energy Information Administration is now, for the first time, seeing stockpiles globally drawing in this quarter. Everybody up until now is being forecasting that they would start to grow again. We've seen the International Energy Agency saying similar, that the market is tighter than people had assumed. Basically, Omicron hasn't had as big an impact on demand as people had feared, and at the same time the OPEC plus group aren't producing in line with their targets. They're about 600,000 barrels a day shy of that at the moment, and that gap is expected to get bigger as the year persists.
Julian Lee, your thoughts on whether we're in the sweet spot right now just for them in terms of prices? Do you think they're satisfied with Brent at 84, WTI at 82? Is that where they want things to be?
I think they're not unhappy with that level of prices. I mean, you know, if you talk to any of the ministers, they sort of shy away from talking about what sort of price they want. But we're certainly not hearing the sort of things that we used to hear in the past, with the right price of oil being $1 or $2 above where it is at the time of asking. They are much more concerned at the moment about balances and about levels of inventory. And I think seeing the market starting to look tighter than they had thought even a month ago is going to raise some alarm signals about the pace of increasing supply.
Julian Lee, as always, sir, thank you very much. This energy story, a big component in the conversation around inflation this morning. A 7 handle. That 7 handle, the headline inflation read, led by shelter and used cars. Energy costs actually turned lower in the last month. You wonder how that develops through the next couple of months with crude back into the 80s. Over in China, inflation actually cooling. The team at China Renaissance saying the following: the probability of a rate cut in the first quarter is high, and the closest window is this month. Consumer inflation will not be a concern in 22. Damien Sassower of Bloomberg Intelligence with us now. And Damien, it's a very different story. The numbers we saw overnight in China and the numbers we're seeing this morning in America.
Well, it's different but the same, Jonathan. I mean, look, U.S. CPI has historically tracked China PPI very, very strongly, certainly in recent years. And so this feeds into the transitory argument. Here in the U.S., you know, China PPI coming in at 10.3% year over year, down from an expected 11.3%. That's a pretty big miss. So, you know, it may feed into the fact that U.S. CPI is going to decline in the coming months, but forget about the inflation data in China. We really need to focus on the total social financing data. And for me, yes, we saw some stabilization, but if you look at China household medium and long-term loans, which is a proxy for mortgage lending in the sector, we know what's going on in the property sector in China, Jonathan. It shows the weakest rise since February of 2020, when basically China was shut off due to the pandemic. And if you look even further beneath the surface, shadow banking, shadow lending, an alternative method of funding corporate and government balance sheets, down for 11 straight months. So basically, yeah, I mean, shadow financing, there's nowhere for mortgage lenders to go, and this is feeding into some of the downgrades we've seen from Moody's and Fitch across the property sector, issues like Shimao and Yuso.
And the downgrade from Goldman on the general economy for GDP growth this year, that weakness concentrated in the first quarter. Damien, how do you think this data out overnight shapes the policy response still to come from the Chinese Communist Party?
I mean, it's going to be more easing. This feeds the fuel for more rate cuts ahead. I mean, we told you yesterday, 50 to 100 bips of triple R cuts are what we expect in full year 2022. I think it's front-loaded. I think we're going to see that sooner rather than later now.
Damien, thank you, sir, as always, to get us up to speed on China and emerging markets as well more broadly. On the S&P 500, up 0.5%, about 21 minutes into the session. On the Nasdaq, up 5 or 0.6%. Breaking it down, your sector price action, as always, here's Kriti Gupta.
Yeah, John, good morning. You are seeing green on the screen when it comes to the S&P 500. A lot of it thanks to having big tech on its side, finally actually driving the index higher. But on a sector basis, a little bit of a different story. Materials and industrials also towards the top. A lot of that has to do with the commodities rally you are seeing. The big message of the day, though, is that it is risk on, whether you look at the stock market or the commodities market. To the downside, though, healthcare, utilities, consumer staples, those are your laggards. Those yielding sectors are in the red. Healthcare in particular is the one that's weighing the index down, though. Biogen is going to be your big story. This coming after the U.S. government limited Medicare coverage of its Alzheimer's disease treatment and similar drugs to patients enrolled in clinical trials. Just take a look at what it's doing to the NASDAQ Biotech Index. Remember, biotech has been something that's really traded and taken the cue of big tech, but lately, in the last quarter, really, of 2021, actually impacted by Biogen's really controversial Alzheimer's treatment, simply not getting approved in Europe or Japan, but getting the nod here in the United States, John.
Kriti, thank you. With the equity breakdown there for you. In the bond market right now, 10's unchanged at 173 off the highs of the year after going in and through 180 on 2s through 90 briefly. Just south of that level, the 2-year coming in a couple of basis points. Not the inflation surprise that some of you were looking for, in line with expectations, a 7 handle. But that 7 handle is a sticker shock for the politicians out there. If this morning this isn't a big market story, it could be a big political one. Coming up on the program, we'll whip through the market events you need to be watching and get you to your trading diary as we work our way through the week. We still have retail sales still to come this Friday. From New York City, this is Bloomberg.
will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
The bottom line is that Ed Hyman sees this economy growing 4.5% in 2022, and that for us translates into 11% earnings growth on the S&P 500, and that's the recipe for higher stock prices, period.
Fantastic to see a good friend of mine in this program, Julian Emanuel of BTIG, now Julian Emanuel of Evercore in a brand new seat, looking for 5,100 year-end on the S&P 500. On the S&P right now, up 0.5% at 47.38, a headline from the Saudi Wealth Fund just moments ago, and on the Bloomberg terminal, looking to invest $10 billion in stocks through the year ahead, through 2022. That's the equity market. Here's the bond market picture. You see the Nasdaq doing nicely there. Yields in on a 10-year. 10 years right now, 173 on twos, just a little bit higher, up a basis point to just short of 90 basis points. Will these moves stick after a morning where we saw 7% CPI? Let's get to the trading diary. You'll hear from the White House with a COVID response team leading a press conference at 11 Eastern. A ton of Fed speak through the week. You'll hear from Kashgari a little bit later. Tomorrow, Governor Brainerd facing her nomination hearing for vice chair. Claims on Thursday, retail sales on Friday, and we kick off earnings season with JP Morgan. Deep breath. What a morning. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to